Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua here in London. Stocks sell off and oil gains as Ukraine risk ripples through global markets. European yields rise in early trade. Diplomatic frenzy while Olaf Scholz heads to Kiev today and Moscow tomorrow. The U.S. warns an invasion may be imminent and Moscow denies any plans to attack Ukraine. Plus, splits on the rate path. The Fed's Mary Daly insists the central bank will be measured with its policy moves, but Larry Summers says a special meeting is needed ASAP to end QE. Now, it is going to be a busy day on the markets. Happy Valentine's Day. A lot of people, market commentary saying, look, this looks like a Valentine's massacre. Certainly when you look at the futures, there's a lot of pressure down some 1.8%. Everyone on tenterhooks on the geopolitics side. So stocks down as worries over Ukraine intensifying, oil extending a rally. And of course, that makes the life of central banks that much more difficult. Now, without a doubt, the one thing I would watch out for is a Bloomberg economic shock model. I love modeling things to see exactly where you see the pressure points. And they say for any climb in crude to 100 by the end of the month, well, it would lift inflation by about 0.5 percentage point in the US and Europe in the second half of the year. So this is the cause and effect. Markets are open. So let's have a look at how they settle. You can see the IBEX down some 2.7%, the FTSE down 0.8%. Now, the reason why there is such a discrepancy between the FTSE 100 and the IBEX is, of course, we have BP and oil majors over, and the FTSE is giving a little bit of support to that index. So stocks really slide in commodities, though, including crude oil surging as geopolitical risks over Ukraine are ripping through these global markets. And so anything that's supported with oil or actually has that support of commodities will do a little bit better than some of the others. Now, I need to show you, for example, the Swiss franc, which is one of the havens. You can see the Swiss franc at 0.9248. As we're seeing a lot of pressure on these markets, for example, you're seeing support for demand in havens such as sovereign debt and the Swiss franc. So this is a picture overall, the U.S. 10-year yield. I know there was joking over the weekend of when do we touch 2.5. It's a 2.5% yield calling. For the moment, we're still below 2. We have a psychological level being, of course, tested last week. Brent 95.28, and then I just want to show you Russian ruble 76.63. S&P futures for the moment practically unchanged. Now, this is without a doubt my stock of the hour. I'm looking forward to also having Mark Cardmore tell me what he's looking at. But this was picked out by Dan Curtis, and I couldn't concur more, although we did talk about whether we should spend a bit of time looking at the price of oil. But look at this. Value has gotten a boost by the rise in yields. It's basically the yellow line compared to growth relative strength. And so it's a good indication of what we could be looking at. This is a 10-year bond yield in blue, and it's a good indication of what market participants should be looking at to tell or to go into this rotation that has started in the last couple of weeks. Now let's get over to the Bloomberg MLife Managing Editor Mark Cudmore for a look at what he's watching in the markets. Mark, I am so happy to have Mark's market minutes actually distilled in a chart, Mark's chart. You have your eye on consumer sentiment today.
Yes, good morning, Francine. I love that last chart, by the way. I do wonder whether it will come from value stocks outperforming or whether growth stocks underperforming. I'm kind of inclined towards the latter. And one of the reasons is my chart today is looking at the US consumer. The data out of the Friday out of the US was really brilliant in terms of it gives you so much information. University of Michigan has become one of the most important data prints that we get at the moment because they have so many different questions and such a long history behind each of them. Now, there are many different ways to break down this consumer, but many different different size and scope about how the consumer in the US is rolling over. The one I like best is looking at the number of people who think their expected change in financial situation will improve over the next year versus the number of people who think it will get worse over the next year. Taking out all the people who are unchanged, don't know, just look at this ratio of optimists to pessimists. Now, there's only been 4 months in the last 40 years where that ratio has been more negative. 3 times in early 2008 and once in 2011. Now, if you look at the 1 month, 2 month, 3 month, 6 month, or 1 year S&P 500 returns average on those 4 occasions, it was deeply negative across the curve. More than 20% was the average losses over 6 month or over a 1 year horizon. Even over 1 month, it was more than 3%. It is very, very clear a negative signal. Now, of course, some eagle-eyed viewers might kind of go, hey, look, Mark, you're kind of cherry picking here because 3 of those months are in early 2008. But that's kind of the point. They were in early 2008. They were in April, May, June 2008. Not when Lehman Brothers went down, way before the kind of financial crisis hit a peak. We're getting a signal from the consumer that the economy and markets were heading into a very, very tough situation. So we're now the 5th most negative of the last 40 years. I am worried where we're heading for the consumer in the US, and that is bad news for global markets.
Yeah, it certainly is. And of course, Mark, there's always a bit of a feedback loop, which we heard from the Bank of Japan trying to break it on the other side. But you wonder, the more we talk about inflation, then of course it feeds into consumer expectations, which could also explain your chart.
Absolutely, and I think it is important to emphasize that this is expectations, Francine. It's not about sentiment right now, it's what they expect for the next year. So the consumer right now is still relatively strong. It has all those payments made during COVID period, and we still have a slight tailwind of growth, but it's saying they are nervous about the environment. That means that they are more vulnerable to change behavior negatively very quickly, both when it comes to stock trading and again to investing, but also in terms of spending.
Yeah, it's as old as time. Worrying about inflation can lead to more inflation. Thank you so much, our Bloomberg MLive managing editor, Mark Cudmore. Now, President Biden has also told Ukraine's Zelensky that the U.S. and its allies would act swiftly and decisively against Russian aggression. Now, Washington says Vladimir Putin may order an attack on Ukraine before the Beijing Winter Olympics ends this weekend. Moscow has repeatedly denied it has plans to do so. Let's bring in Bloomberg's Europe correspondent, Maria Tadeo. Maria, I mean, it seems like this is a very decisive week, a very difficult week diplomatically. Have we actually exhausted all of the diplomacy, and are we just in a wait-and-see situation now to see what Vladimir Putin will do next?
Well, Francine, I would say it's a combination of both. On the one hand, we have seen a lot of diplomatic efforts over the past 48 hours. A lot of this, of course, kicking off on Friday after a report suggested that this invasion could be imminent, but it's imminent perhaps as Tuesday. That was the first time we heard a date for this invasion. Of course, the D.C. and the White House is not denying the date, but they're not also saying that it's not beyond the realm of possibility. Now, we do have this week the German Chancellor going to Ukraine today, where he's expected to talk about money and financial help. This is a country and an economy that is already hurting. And then tomorrow he'll be going to Russia and meeting Vladimir Putin for the first time. Now, this is the first time the two will meet face to face, and it is the first time where the Germans could have the platform and the possibility to tell the Russians in Moscow, if you do invade Ukraine, we will stop the Nord Stream 2 pipeline. So there is a huge focus between this meeting tomorrow. Again, keep it in mind that Olaf Scholz is untested in the grants of foreign diplomacy and Russian diplomacy, and he is very difficult or very different to Angela Merkel, who was a fluent Russian speaker.
Yeah, I have to say, all of the accounts from the UK diplomats that showed up, of course, in Russia, but also Emmanuel Macron saying this is a very much tougher and more insistent Vladimir Putin. Thank you so much, Maria Tadeo in Brussels for now. Joining us is Sharon Bell, Goldman Sachs Managing Director of European Equity Strategy. Sharon, as always, thank you so much for coming on. I don't know how you play the Ukraine situation, but certainly you could have a feedback loop into inflation, which would be a game changer for a lot of central banks.
Completely. I mean, this couldn't come at a worse time, really, in a way. Growth is slowing, inflation has picked up. So an additional sort of heightened risk environment that you would get between Russia and Ukraine, it's just adding into that mix. Oil prices are already high. It's likely to push up energy costs, etc., and inflation. So it's certainly unhelpful. The only thing I would say on the flip side of all of this, of course, is that markets have already come off a little bit year to date, and people are aware of the risk.
So, Sharon, this is extremely, difficult to call because it is, at the end of the day, down to Vladimir Putin. No one really has an insight into his brain about what he's thinking or if he wants to invade or not. But as, a tactical allocation manager, what do you do? Do you sit on the fence, or do you actually have to make a call on whether, we go to 100 oils, 100 barrel in oil and upwards?
Well, I think, you don't have to make, you can, as you say, shift your portfolio to reduce the risks, even if you're not making an absolute call on what you think Putin is going to do. So, for example, we recommend being overweight commodities as a sort of asset class relative to others, and also within, say, the equity market, being overweight energy stocks. So you can hedge yourself a little bit in that manner. We also, this morning, within our asset allocation, have recommended an overweight in cash. So we've got an overweight in commodities, equities and cash now, and an underweight in bonds and credit. And that overweight we now recommend in cash is a little bit to balance some of these risks.
And Sharon, I know you're still quite bullish on European equities. Why so?
Yeah, I am, although, absolutely, undoubtedly, this is a nasty risk for European equities. Europe is at the sort of epicenter of global trade anyway. Any risks like this raise the risk premium, they reduce the valuation of the market, etc. So it's unhelpful for that view. But the reasons I'm positive on European equities is the valuation. It's not expensive, sort of on a PE of 14.5 times for this year's earnings. That's long-term average, really, for European stocks, not expensive at all, given that interest rates are still very, very low. And then we're expecting a reasonable sort of reopening growth recovery in Europe this year with some fiscal spend as well. So those things, I think, compensate quite a lot, but clearly this is a near-term risk.
Sharon, without a doubt, one of my charts of the week is basically looking at value stocks, and this is what we got put up, and we can do this with the Bloomberg terminal. Basically, value has gotten a boost by the rising yields. That's pretty self-explanatory. Yellow line is value compared to growth relative strengths. Where do you sit on this debate?
Yeah, I love your chart. I think it's definitely been boosted, as you say, that this rotation to value stocks has been boosted by rising real yields. We do expect real yields to rise further this year by sort of another, if you're looking, say, at the 10-year yield, another 30 basis points globally. So that would tend to help value companies. Also, I think some pockets of value companies are actually structurally improving. Yes, they are value and they're not growth, and they're not sort of long duration growth assets. But things like banks, they've improved their capital ratios, their non-performing loans have fallen. The telecom sector, we think, is getting a little bit more pricing power. Energy, obviously, with the rising energy prices, and they're making great cash flows at the moment. So we think there's large swathes, I would say, of value that are genuinely fundamentally doing well, as well as that interest rate move.
Sharon, what do you do with Italian stocks right now? I know there's a differential, especially what we've heard from the ECB in the last couple of weeks. If we have a widening yield or spread between German German bunds and Italian BTPs, does it mean that you would sell off some of the Italian assets?
Yeah, it's a tricky one because, again, that's obviously a clear risk for Italy, that you get a further widening of sovereign spreads, and they have widened a little bit. I would say that Italian stocks so far have been quite resilient relative to the rest of Europe to this widening spread environment, more so than they were, for instance, during the sovereign crisis. But then sovereign spreads became, I think, as wide as 400 basis points in that crisis back in 2012, whereas now we're looking at sort of 150, maybe a little bit more than that in terms of sovereign spreads. So it's not, I don't think we're as big a problem as we were back then. Also, I would argue the Italian market is very buffered by the fact that economic growth in Italy will probably be pretty good this year. That reopening trade I talked about, where do people go when they're starting to enjoy a bit of reopening? Travel, tourism, leisure, that will, I think, really boost the Italian economy in 2022 and 23. Plus, they've got quite a lot of money to spend from that recovery fund pot that Merkel and Macron put together, and that money's starting to be spent this year.
Sharon, thanks so much. Sharon Belder, Goldman Sachs Managing Director of European Equity Strategy, of course, is staying with us. Much more on the markets coming up next. We'll have plenty more, of course, on Russia, Ukraine, how you play that. A bit of pressure on, well, the commodity stocks are on this up, but actually the rest of the market is being sold off. You can see the FTSE 100 down to 1.4%. This is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open, everyone. 15 minutes into the European trading day. And of course, a lot of the focus is in what's going on with Ukraine. So a lot of pressure on a lot of these markets. The European stock 600 down 2%. The DAX down some 2.5%. The focus not only on Ukraine, but of course on the commodities. And our Mark Cudmore had this great chart on consumer expectations. And this, of course, is a feedback loop. The more you think inflation is here, the more inflation goes up, the more it's tough for central banks to keep it in check. And that underpins everything that we're seeing in the broader market. We're seeing havens bid in terms of bonds, but also the Swiss franc because of all the uncertainty surrounding Ukraine. The other story we're watching out for, and this is one stock that's really moving at the open, Clariant. You can see down 16%. It delayed publishing its full year results amid an investigation into its accounting after internal whistleblowers warned that the Swiss company may have incorrectly booked provisions and accruals to meet financial targets, and that stock is getting slammed down 15%. Now, let's also take a look at some of the events that we're following throughout the week. Today, the German Chancellor, Olaf Scholz, travels to Ukraine for talks with President Zelensky. BHP and Glencore then kick off the latest round of earnings from top miners when they report on Tuesday. UK CPI on Wednesday, with economists forecasting annual inflation at 5.5%. Then on Thursday, it's Turkey's rate decision. Consensus forecast points to the central bank keeping interest rates unchanged. And finally, on Friday, French CPI for January. Now, to talk us through the week, and of course, a big markets heavy day. Still with us, Sharon Bell, Goldman Sachs, Managing Director of European Equity Strategy. Sharon, what do you like in these European equities at the moment?
Well, within European equities, because I feel pretty positive about European equities. I mean, there's near-term risks, and Russia-Ukraine would be the number one, I would say. And then, of course, this rising inflationary environment. But of course, Europe was battling the last 10 years for a deflationary environment. So a little bit more growth economically because of reopening, a bit more fiscal spend, a little bit more inflation, slightly higher interest rates perhaps toward the end of this year. I think that will be helpful for banks, which are quite domestic sector. They will benefit from better economic growth and from slightly higher interest rates. And then the energy stocks as well, which are a big hedge too, if you're concerned about political risks and geopolitical risks. So we like banks, we like energy. I do think there are some pockets of value within, say, the tech sector, but for that to be realised, I think you need to stop expectations of interest rates going up, and that they've gone up very, very sharply. And as long as they continue to rise, I think that sector will struggle.
Sharon, what surprised you the most in some of these earnings that we saw over the last 2 to 3 weeks? I was surprised by the fact that, you know, there's a focus on margins, but also a focus on inventories. But if there's disappointment or if there's a whiff of inflation where companies cannot raise prices, their share price can lose some 10, 15%.
Yeah, absolutely. So what we found is the earnings season wasn't too bad. The overall sort of average earnings surprise so far has been sort of mid-single digits in Europe, positive earnings surprise, which has been great. So it's been an okay earnings season. Not as good as the last 3 or 4, which were really sort of pandemic recovery earnings seasons where there was really large earnings surprises on the positive side. This one already analysts had higher forecasts embedded, so the surprise has been much smaller, but it's still been positive, which is great, with most companies reporting either in line or above expectations. But you're absolutely right. The pockets of companies that have disappointed, where that's been the case, they've been hit very badly by the market. And even the companies that have been in line or slightly positive, you haven't necessarily seen a strong positive market reaction. So I think it's more the subdued reaction by the markets. We haven't seen a huge margin hit so far still, which in some ways is a bit surprising. All the way through last year, margins were upgraded. So far this year, margin expectations are really kind of flat, but they haven't come down yet.
So what are you expecting for inventories? I do feel like the switch has suddenly been on inventories and whether we can replenish some of them.
Yeah, so it depends where you look, but inventory levels are particularly low. And the auto sector is the good example where there really is no inventories. Dealers have no inventory at all. But across the industrial space in general, inventories are extremely low, largely because we haven't been able to manufacture things or transport things around the world, given COVID restrictions, and just given extra costs generally. So I think it's going to take a long time to replenish those inventories. They will start to be replenished, but it will take a long time. In some ways, though, this is a good thing because ultimately it means that you can have a bit of a positive inventory-driven cycle. Even if demand starts to slow a bit, eventually you'll get this pickup in inventories.
Sharon, overall, I know you're also looking at the companies with a weaker balance sheet. Do you think they'll be slammed as we get into the second and third quarter?
I think they are vulnerable. I suppose I would probably put less of a dramatic word as slammed on them, but I do think they'll be a bit vulnerable. Absolutely. Interest rates are going up. We've just discussed that. And then not only is the bond yield going up, but credit spreads are rising on top of that. So the cost of borrowing, if you're already vulnerable, is going up. And at the same now, this will be absolutely fine as long as there's reasonable economic growth, which we kind of forecast for this year, which is why I feel that they're vulnerable rather than they're going to be slammed. Now, if growth does weaken more than we expect, this consumer sentiment chart your colleague was showing earlier, if that feeds through into lower demand, lower economic growth, it weakens much more rapidly. And on top of that, you have higher interest rates and higher credit spreads. And clearly the companies with the weak balance sheets are going to be quite vulnerable. Just one final point on that, though, is there aren't that many companies like that. We struggle to put together a list of companies with really weak balance sheets.
Sharon, thank you so much, as always. Sharon Bell there, smart. Goldman Sachs Managing Director of European Equity Strategist. Now, coming up, tense diplomacy. President Biden promises a swift response if Russia invades Ukraine. Crude rallies pushing towards $100 a barrel. Much more on that throughout the program. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the Open, everyone. 24 minutes into the European trading day. It's big markets day. Stocks falling, oil jumping amid all of the tensions that we're seeing in Ukraine. Now, stocks are sliding. Commodities, including crude oil, are surging. A couple of other things that we're watching out for. Treasury yields actually edging higher. German yields declining. The dollar pretty much steady. And we're seeing haven bids, including the Swiss franc, taking a bid. So we'll have plenty more, of course, on what this means for some of the other less-known commodities. Russia, one of the major producers of metals, including aluminum and nickel. Palladium also, they do about 40% of palladium used in catalytic converters, so we could see a huge swing if there was something ugly with an invasion happening in Ukraine and some of these specific commodities. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Clariant shares have plunged after it delayed publishing its results and started an investigation into its accounting after internal whistleblowers said it may have incorrectly booked provisions and accruals. The Swiss chemicals company says it may need to restate results for 2020 and for the first half of this year. BP, Shell, and several other oil majors are generating their highest free cash flow since the start of 2008, when oil first climbed above $100 a barrel. But despite the outsized returns, BP's CEO has told Bloomberg's Francine Lacqua the company is refocusing its business.
People think about the energy transition must be a threat to a company like BP. I don't think like that. I think it's an enormous opportunity. We're going to go into EV charging. We're going to go into biofuels. We're going to go into hydrogen. These are things that we can help solve. And instead of thinking of it as a risk or a threat where you crouch down in a defensive position and you see darkness, it's actually a massive opportunity for us.
You can catch that full conversation with Bernard Looney on Leaders with Lacqua. That's airing later this month on Bloomberg Television and Bloomberg.com. That's the Bloomberg Business Flash, Francine.
Laura, thanks so much. Laura Wright in London. Now, we're also looking at the price of oil extending or rallying. That's put $100 a barrel, of course, in sight as soaring demand and indicators that point to near-term scarcity and the impact, of course, of tensions in Ukraine. Coming up, a rush in changing monetary policy could harm the euro area pandemic recovery. That's a warning from an ECB governing council member, so we'll have plenty more on that after the break. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a third dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Stocks sell off and oil gains as Ukraine risk ripples through global markets. European yields fall in early trade. Diplomatic frenzy. Olaf Scholz heads to Kiev today and to Moscow tomorrow. The U.S. warns an invasion may be imminent. Moscow denies any plans to attack Ukraine. Plus, splits on the rate path. The Fed's Mary Daly insists the central bank will be measured with its policy moves, but Larry Summers sees a special meeting is needed ASAP to end QE. So let's go straight to the markets. A lot going on, and we're seeing quite a big sell-off when it comes to European equities. So here in Europe, we're down some 2.5%. Similar amount of pressure on some of the individual stocks. So the DAX, for example, down 3%. Again, stocks are down on worry about Ukraine intensifying, oil extending a rally. That means that there could be a feedback loop also into what central banks do. Now, with tensions running high, all eyes will be on the German Chancellor Olaf Scholz's visit to Ukraine today ahead of a meeting with Vladimir Putin. But also, I imagine we'll get a lot more of the central banks to come out with ideas or panning out exactly what this means. Without a doubt, my morning must-read comes from Bloomberg Economics, and it's their shock model, SHOK. Now, basically models out what the correlation is between crude and the price of, and how inflation climbs up. So they say a climb in crude to $100 by the end of this month from around $70 at the end of 2021 would lift inflation by about half a percentage point in the US and Europe in the second half of the year. But you can see all industry groups are down: travel and leisure, banks, auto parts, with, I guess, just some of the basic resources holding up. But the other thing we need to watch out for is, without a doubt, one of the best terminal charts that we've seen today. Now, our Mark Cudmore had a great one in terms of consumer sentiment. That's a story of inflation. I had a pretty good one thanks to our Dan Curtis looking at value stocks getting a boost by the rising yields. But this is what underpins everything. Now, it's basically looking at the Fed, the ECB, and the BOE hikes, and it's in basis points and what they're expecting for the year. So this is, the European Central Bank all the way below in blue, which is why it could be a story on differential, and actually you play that between a European Central Bank and, of course, what we're expecting from the Bank of England. It was interesting to hear from the governor of the Bank of England, Andrew Bailey, for many times saying that actually they did not want to really lead. I mean, he didn't say it explicitly, but they probably don't want to lead the world into a hiking cycle, but they are ahead of the curve after being told that actually we're probably behind the curve in December. So that's the main thing that we're looking out for, and then look out for energy stocks, of course, bucking the trend, climbing as oil added to an 8-week winning run. Palladium, wheat, both of which see significant portions of the global supply coming from Russia or Ukraine, also advancing, and then European gas prices up as well. Coming up, tense diplomacy. President Biden promises a swift response if Russia invades Ukraine. Crude rallies pushing towards $100 a barrel. That story is up next, and this is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back to the Open, everyone. 36 minutes into the European trading day. Of course, a lot of pressure, as we all know, on some of these stocks. The DAX down some 3%, the CAC 40 down some 3%. The FTSE actually not down as much because it is quite oil rich and so benefiting from the oil price getting to around, well, close to $100 a barrel. I mean, this is a huge psychological level, but because of BP and some of the other ones, it is still being supported by that. Stocks overall, of course, sliding. Commodities, including crude oil, surging as geopolitical risks over Ukraine are rippling through global markets. That, without a doubt, is the story of the day. We'll see how it plays out. We have shuttle diplomacy between Olaf Scholz going to Ukraine today and then Moscow tomorrow. The other thing I would watch out for, Treasury yields edging higher, German yields declining, the dollar pretty much steady, and then there's palladium, wheat, and of course natural gas also on the up because they mainly come from Ukraine and Russia, and so anything on the ground that would happen would impact those as well. Now, an ECB overreaction on prices could stimulate growth. That's the warning from the ECB Governing Council member Olli Rehn. He told reporters if we reacted strongly to inflation in the short term, we would probably cause economic growth to stop. Well, let's get into the outlook for Europe and the monetary policy environment. Joining us now is Dean Turner, European economist at UBS Global Wealth Management. Dean, thank you so much for coming on today. I mean, this is a concern, is that I guess inflation's going up, so they need to tell a signal to the market that they need business, but there's a danger that they actually really hurt economic growth. So what's the right way of the ECB to message this to the markets?
I think that the ECB just have to really be very clear in their intentions and also guide the markets in terms of how this process is going to be managed. Now, you know, the next meeting on March the 10th will be key because then we'll hear more about their intentions for the asset purchase program and the QE program more generally. And you know, I think it's via that communication as well as signalling some intentions around rate hikes that they can keep the markets on board.
So what exactly do you think is priced in, Dean, at the moment in the markets? And is the market overpricing a hawkish ECB or underpricing it?
I think the market's pricing a little bit too hawkish at the moment. I think by the year end, there's a pretty good chance we do get to zero, assuming that they end APP at some time in the third quarter. The second quarter. That would give them the chance to hike perhaps in September and December. But my sense is that the market's expecting those moves to come a little bit sooner. So you know, whilst I wouldn't disagree too much on the end point, I think it's more the timing that I think the market's been a little bit too optimistic on.
So what's the timing that you're looking at, Dean?
So we're looking for a hike, the first hike to come in the September meeting. We're looking for the second hike of 25 basis points to come at the December meeting, and hopefully that would get the deposit rate up to zero. And then beyond that, we think that next year it's going to be very much a steady progress of further tightening, with perhaps 3 more hikes of 25 basis points next year.
Dean, is there something to be said for, I mean, the market seemed to be getting ahead of themselves, really, because of all the signaling from the Fed. Is the market mispricing things because of Fed? So every time we see inflation actually go up in the US, will it move also rates in Europe?
Yeah, absolutely. Look, we're seeing all the rates curves. It's whenever we see moves in the US. I noticed that, for example, in the UK, you know, we're pricing 4 more hikes this year in the UK, and that just doesn't seem realistic, especially on the back of what we've heard from the Bank of England. So yes, there is that connect, and it is causing some overly aggressive assumption. But you know, look, the broad narrative of monetary policy becoming tighter as we head through this year, I think is sound. It's just, you know, we would just question the speed of that adjustment.
Dean, when you look at some of, you know, the unknowns, known unknowns, I mean, we have no idea of what happens with Russia and Ukraine. If there if there were an invasion of Ukraine by Russian troops, how does it play out on inflation?
Well, I think the key thing to watch in the first instance will be what happens to energy prices. We're all well aware of Europe's dependency on Russia for gas, and you know, any disruption that there could be to supply would in the short term perhaps be negative in terms of what happens to inflation. But you know, that's going to be the first order effect I think we have to watch. Beyond that, then we'll just have to see how things resolve. A lot will depend on the level of sanctions and the reactions on both sides. But unquestionably, in the short term, it's probably more negative news. But you know, in terms of policymaker reaction, there's not really much that central banks can do to combat such a supply-side shock. So, in my mind, if we were to see energy prices higher, that doesn't automatically translate into central banks tightening more aggressively.
Dean, do you see yields in German bonds and Italian BTPs continue to widen from here?
I think that as we go through this year and we do get to a situation where we are seeing rate hikes, we can see that spread widen. But we're not expecting that we see that this moves out to, you know, levels that we saw a few years back, and certainly not anything that we saw during the Eurozone financial crisis.
When we look at, you know, some of the energy crisis, and if we impose sanctions on Russia, would that be even, I mean, is that where the main pain would come from? I know we're also looking at, you know, the fact that Russia has 40% of palladium, Dean. So is there something, you know, could the shock be much bigger than just inflation?
Yeah, so it is certainly more widespread. Obviously, we have to be aware that Ukraine is a significant exporter of agricultural goods. So we could see further price pressures there. I think it's, if we were to see tensions, I think we do have to accept that we will get a more persistent story on the inflation picture that is a little bit more broad-based, perhaps, than just in energy costs.
Dean Turner, thank you so much for joining us, European economist at UBS Global Wealth Management, joining us today. Now, let's focus in also on the geopolitical situation that we were just talking about with Dean. President Biden has promised swift action if Russia invades Ukraine. Moscow has repeatedly denied it has plans to do so. Meanwhile, oil pushing towards $100 a barrel as geopolitical tensions escalate. Well, let's bring in Bloomberg's Europe correspondent, Maria Tadeo, and our executive editor for energy and commodities, Will Kennedy. So, Maria and Will, thank you both for joining us. A weekend, Maria, of hectic diplomacy, unconclusive. What's next?
Yes, Francine, and just to remind everyone, of course, the thing that kicks off this whole frenzy is a report on Friday suggesting that a Russian attack is imminent and could be as early as tomorrow, and that it would target the Ukrainian capital. Now, the White House did not confirm that date, but they do not deny that they believe an attack is imminent. Now, this sent, of course, everyone into a spiral that's very much reflected in market action today. When you look at over the weekend, we did have Emmanuel Macron on the phone again with Vladimir Putin. This is the fourth call they have. Emmanuel Macron told Vladimir Putin an honest and sincere dialogue means that there could be no escalation in the future. And then another final warning from President Biden saying the repercussions on this Russian economy would be severe and they would be swift. Now, this is for the weekend, but really the point of action now is that trip from Olaf Scholz going to Russia tomorrow. This is the first time Vladimir Putin and Olaf Scholz will meet face to face. And of course, the real focus here will be on just how far is Germany willing to go when it comes to the economic punishment, knowing the German economy will also be hurt, but also the Nord Stream 2 pipeline. This is the first time and the first opportunity he will have to say and make it very clear to the Russians, Nord Stream 2 could be canceled if there is an invasion.
Maria, the next, of course, stop is for Olaf Scholz is Ukraine today, and then Tuesday, tomorrow, Russia. What are we expecting, if anything, from then?
Well, I think when it comes to today in Ukraine, for Olaf Scholz, it really will be about financial solidarity with the country. We did hear from the Ukrainian President Zelensky over the weekend, now very irritated, saying that a lot of the dates that are being thrown around, a lot of the reporting that is being pushed around is creating panic in the nation, and it's already creating a lot of damage in the Ukrainian economy. We're seeing today, Francine, that a lot of flights are simply not happening, and the Ukrainian airspace is very, very limited when it comes to those commercial flights, with a number of airlines already saying they're not going to be flying into the airspace. So the damage is already very real, and we're not even in an invasion scenario. So a lot of this will be about providing financial help to Ukraine. Tomorrow, of course, is this big tete-a-tete between Olaf Scholz and Vladimir Putin. This is a very different chancellor to Angela Merkel, and this is his very first real test when it comes to Russia.
Yeah, we also heard from Emmanuel Macron that Vladimir Putin seems much harsher than in the past. Well, what does it mean for the price of oil? I mean, we're inching towards $100. I guess, and I don't know when this ends. Whether, if we don't have an invasion and we stay in this kind of trickled, heightened security concerns, could we see 100, 105, 110 until the summer months?
I think if there is any sort of military action here, that we will quickly see prices spike, probably to $100. We saw on Friday when the US gave these startling briefings about their views of Russian intentions, of course, that Russia has played down, that oil rallied very sharply. And I think that reflects concern that this would be one of the biggest geopolitical events in years. Russia, of course, is the world's second largest oil exporter after Saudi Arabia. And while there's no guarantee that any conflict in Ukraine would limit Russian exports, it, of course, is a concern. It's worth pointing out, though, that there are other things in the background driving oil higher. Clearly, demand is very strong. Clearly, supply isn't quite catching up. So we've got this against the background of already bullish supply-demand dynamics. The one thing pulling perhaps in the other direction is Iran talks. It does seem that the diplomacy in Vienna is making some progress. And of course, if there was a deal over Iran's oil exports, that could allay some fears about the tightness of the market.
Well, I mean, there's a couple of things. I think last time you were on a couple of, a couple of weeks ago, we were talking about swaps, and there's, quirky places in the markets now. Dated to frontline swaps, which is one of the charts that we're looking at now, typically used to hedge or speculate on the difference between physical crude price and futures, are also going up. So is it that people are actually trying to get hold of barrels of oil in the market?
The market in the near term, right at the front of the curve, people who are trying to buy oil for the next few weeks, those markets that you're talking about, Francine, are clearly signalling a tightness in the market. Now, I don't think that really reflects the geopolitical situation more than just the physical supply and demand dynamics that we've been talking about. Stockpiles have been falling around the world. People are keen to refine oil into fuels. Those refiners are willing to pay to get their hands on oil right now.
Thank you so much for joining us. Will Kennedy there and our Maria Tadeo. Now, coming up, we'll have plenty more, of course, on oil, also palladium and wheat that comes from Russia and Ukraine. Also, a conversation with the BP chief executive, Bernard Looney, including his comments on UK energy prices. That's coming up next, and this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Wherever you get your news.
This is Bloomberg Daybreak with links.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open, everyone. 51 minutes into the European trading day, and you can see European stocks getting a slam. The DAX down 3%, the CAC 40 down 3.2%. Of course, commodities on the up, including crude oil, surging as geopolitical risks over Ukraine are really rippling through global markets. Now, palladium and wheat, both of which have a significant portion of the global supply coming from Russia and Ukraine, also jumping. European natural gas and electricity prices also jumping. If you look at bonds, so Treasury yields edging higher, German yields declining, the dollar pretty much steady. We are also seeing a bid for the Swiss franc, so there's definitely a rotation into some of the risk-off mood that we're seeing. Tensions over Russia's military has been building up in the last couple of weeks, but it does seem to be really coming at the forefront this week. Now let's focus in on the energy story. As the UK and Europe continue to face an energy price crunch, oil companies have faced political and public pressure. BP is one of those oil majors after raking in its highest profit in almost a decade in the fourth quarter. Well, I sat down with the BP chief executive, Bernard Looney, and got his reaction on the calls for higher taxes as well as the achievability of net zero targets.
There is a great debate in the UK at the moment around a windfall tax. You know, the first thing to say is, you know, I think when you do hear the stories, and you and I are probably in a very privileged position, but when you hear the stories about people having to have to choose, you know, it's a terrible situation, right? Now, you say, well, what's your role in that, and what can you do to help that? I feel that our job is to make sure that the energy is there as best as possible, as much of it as possible. So what we would say is you need two things. You need more natural gas production in the UK, because one of the reasons we have an issue is because there's an imbalance. So we should be incentivizing the investment in natural gas, not disincentivizing. And the second thing that we should be doing is trying to accelerate the transition. And that's why we said this week that actually this decade in Britain, for every pound that we make, we're going to invest £2, and that £2 is going to go into the accelerating the transition in wind and hydrogen and EV charging.
A lot of analysts, and especially ESG ones, say, look, BP is best in class when it comes to this. It's still in maybe a dodgy neighborhood because of the nature of what you do, but best in class. Are you confident that we'll get to the targets set out by COP26? Can we, if not reverse, at least stay and stop climate change?
Well, I think we have to be optimistic. We have to have confidence. What I would say is, I come back to something Francine and I talk about, which is greening companies. And what is a greening company? A greening company is a company that is carbon intensive today. You might call it a heavy polluter today. And what we need to do is to back and encourage those companies to get to net zero. We need green companies, of course. We need solar companies. We need wind companies. We need battery companies. But the reality is we won't be able to build enough of them and scale them fast enough. What we need to do is take companies like BP and get them to transition to net zero. And that's what we're doing. Carbon intensive today, net zero tomorrow, a greening company.
Well, that was the BP Chief Executive, Bernard Looney, and you can catch that full conversation on Leaders with LACWA. That's airing later this month on Bloomberg TV and Bloomberg.com. Now let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. The Ambassador Bridge that links Ontario with the US has reopened after a 5-day protest against vaccine mandates stopped traffic. Authorities started clearing demonstrators on Saturday before working to remove barriers erected at the site. The protest halted the movement of goods worth almost $14 million an hour. Hong Kong is warning of a crisis after local media say another 1,500 positive COVID cases are set to be reported today. Authorities say that's threatening to overwhelm hospitals and upend the city's COVID zero strategy. Hong Kong says cases exceed hospital capacity and priority will now be given to the elderly and children. Swiss voters have backed a ballot measure to protect children and young adults from tobacco advertising. Some 57% supported the initiative, only the 25th time that's happened in a national vote. Switzerland has strong ties with the tobacco industry, including a global research facility for Philip Morris International. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thank you so much. Laura Wright in London. Now, this is what U.S. futures are telling us. A lot of pressure, certainly, on European stocks after we heard reports over the weekend about a possible Russian invasion as soon as this week. Now, stocks falling overall. Geopolitical risks over Ukraine really rippling through global markets. Oil fluctuating after earlier gains. U.S. and European bond yields actually declining and the dollar ticking up. Now, tensions over the military buildup of Russia near Ukraine now entering a potentially decisive week with the U.S. warning an invasion may be imminent and President Vladimir Putin accusing America of failing to meet his demands. So we'll have extra market checks to follow any movement. That's it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
The Fed clearly needs to start hiking rates and probably not shock therapy, definitely not shock therapy.
Higher prices causing inflation. It's not in the interest of consumers, but not in the interest of producers either.
I feel that our job is to make sure that the energy is there as best as possible, as much of it as possible.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Diplomatic frenzy. Olaf Scholz heads to Kiev today and Moscow tomorrow. The U.S. warns an invasion may be imminent. The geopolitical risks over Ukraine ripple through global markets. European stocks fall in early trading. And a Hollywood ending for the Rams, while the Los Angeles-based team win the Super Bowl after scoring a late touchdown. Now, first thing is first, we'll get into the Super Bowl a little bit later from a business angle. We'll talk you through the numbers, but the markets, look at the markets. I mean, we've never really seen anything like it in the last couple of months. The European stock 600 down some 2.8%. There was intelligence over the weekend from the U.S. that there could be an imminent invasion of Ukraine by Russia, something that Russia has denied. But this is repricing a lot of the markets, tensions over the military buildup, now warning, of course, of an invasion being imminent, means that we also need to look at the psychological effect that it does to inflation. So we have palladium up. 40% of the world's palladium comes from Russia. We have wheat prices up. And of course, energy gas prices at a time where already it's extremely tricky for central banks to decide what to do with inflation. One of the biggest, the industry groups that's losing the most is travel and leisure, down some 4%. And then we're seeing haven bids across the board, a bid for a lot of these bonds. The German 5-year yield at minus 0.001. NYMEX crude at 92.98. Now, again, the uncertainty really that we have over the price of oil as we edge up over towards 100 is another blow to markets that are really already pretty skittish when it comes to inflation and also the prospect of aggressive Federal Reserve hike. Now, the difference between, for example, a CAC 40 that's down some 3.5% and a DAX that's, I think, down some 3% in the UK is the fact that actually the UK and the FTSE 100 is down by less because it still has support from companies like BP. So as the price of oil goes higher for these, it lifts, of course, the FTSE 100 as a go. But you can see a sea of red. Again, everyone on tenterhooks with this shuttle diplomacy with Olaf Scholz going to Kiev today and then to Russia tomorrow. So more on this Ukraine crisis. President Biden's national security advisor, Jake Sullivan, says Russia could invade Ukraine at any time, despite continuing some of these diplomatic efforts. Now, Moscow has repeatedly denied any plans to do so.
The way they have built up their forces, the way they have maneuvered things in place,
makes it a distinct possibility that there will be major military action very soon.
Let's bring in Bloomberg's European correspondent Maria Tadeo. So Maria, a weekend of hectic diplomacy, little to show for it. What's next?
Yes, Francine, and what a 48 hours we had. And a lot of this, just to remind everyone, as you said, it really kicks off on Friday. There is a PBS report suggesting that this attack is imminent. They put a date on it. They say it's Tuesday, so tomorrow, and that it would target the Ukrainian capital. Now, when you look at what the White House is saying, they're not confirming any dates, but they still say this attack is imminent. Of course, this sent everyone on a spiral. We've heard from Emmanuel Macron over the weekend. That is the fourth call between the two, saying that honest and sincere dialogue means there can be no escalation, and another warning about swift and very severe sanctions on the Russian economy if there were to be an invasion. Now, what is interesting here, Francine, of course, is that the Russians keep saying this is Western hysteria. They are trying to create panic in Eastern Europe and then blame it on Russia. The other thing, of course, that we're looking very much on is that trip from Olaf Scholz going to Ukraine today and tomorrow meeting Vladimir Putin. For the first time, there will be a face-to-face meeting between the two of them.
Yeah, I mean, the concern is that there's more and more troops. It has gone from 100,000 to 130,000 troops. So the next stop is, Olaf Scholz in Ukraine today and Tuesday. What are we expecting from that? Any possible breakthrough?
Yeah, and well, Francine, on the troops, what the Russians say is that this is happening in their territory, and that they do not confirm the numbers that the Western allies are putting forward. But we also heard from NATO that they have seen, or they believe there has been an incremental jump in the past 2 weeks. Now, in terms of this breakthrough, this will be a huge test for Olaf Scholz, who is slipping in polls. He has been accused of being soft on Russia. The SPD as a party has been accused of meddling too much with Russian authorities, and tomorrow will be a first platform for him to say very clearly, put an end to the ambiguity around Nord Stream 2. Whether he does it or not, what really remains to be seen.
Maria, thank you so much. Maria Tadeo there with the very latest, of course, on the situation in Ukraine. Now, we're joined by Mike Bell, Global Market Strategist at JP Morgan Asset Management. Mike, great to have you on a day also where the market are really concerned about what's happening with geopolitics. We can't read Vladimir Putin's head. So as a portfolio manager, how do you play this?
Well, I think clearly it's a significant risk, and it's one where the uncertainty is elevated, not just on whether there'll actually be an invasion, but what the Western response to that would be, and then the impact on energy prices. But with energy prices already so high and that squeezing real wages, further shocks, I think, do pose a risk. So I think, to me, it makes sense to be dialing back one's risk positions a bit, not overreacting, but just moderating the size of risk positions and getting a bit closer to neutral than one would otherwise be.
Mike, what happens if there's not an invasion, but actually, consumers almost like go into a frenzy of thinking that there's inflation, which will feed to I don't know if it's automatic, but will feed to higher inflation. Like, how do you protect yourself against that?
Yeah, I mean, I think they're different risks, because if you have the real wage squeeze, that's going to weigh on people's ability to spend on other non-energy goods. And then eventually that would moderate the inflation pressure and have different implications. Whereas if it starts to feed through into a wage price spiral, which is what everyone's really concerned about, that's obviously the worst case scenario, where you get high inflation and you've got this hit from energy prices. That's really quite difficult to hedge, other than with something like put options or derivatives to try and hedge some of that risk out. Because I think it would weigh on some of the higher valued stocks at the same time as, weighing on risk assets more broadly. So I think, looking out there at the moment, probably just makes sense to dial that risk back a little bit and have less of an overweight than one would have had if this was not the case.
Mike, give me a sense of how you play this. How do you, what happens, for example, to bond yields in this environment? What do you buy into?
Yeah, it's very hard to say, frankly. I mean, with bond yields, obviously higher inflation, all else equal, you would think if you get that wage price spiral, then it leads to central banks putting rates up further. But I do think the risk for those higher oil prices is that it's going to weigh on growth, because it's essentially a tax on the consumer. And so if anything, when I look at the pricing that's currently baked in for this year for bond prices, it seems to me like it's more likely that rates go up a little bit slower than is currently being priced. I think eventually rates are going to rise further than is being priced, unless this ends up causing a significant hit to growth.
Mike, there's something that really caught my eye, and actually I don't know how you model this, and it's extremely difficult. So I know it's like, you know, for you it's probably a nightmare day to go on Bloomberg TV to try and explain how you look at this, but Bloomberg Economics has something called a shock model, CHOK, and basically they say that a climb in crude to $100 a barrel from, you know, $70 at the end of 2021 translates into inflation going higher by about half a percentage point in the US and Europe in the second half of the year. I mean, that's huge for central banks.
Yeah, I guess it comes down to how persistent it is, which is, you know, what we've been talking about for over a year now. But it comes down to me to the fact that you can't avoid this, right? Obviously, in the long run, it'd be great for people to be able to switch away from fossil fuels. But at the moment, people don't have that option in a very sort of quick way. And therefore, it is going to reduce the amount that people have to spend on other things. Now, particularly in the US, they've still got pretty elevated savings. Our data suggests that household deposits are still about 80% higher than they were pre-pandemic. So it's probably not going to cause a recession, but it does mean that they've got less money to spend on fun stuff than they otherwise would do. And so that could actually end up dampening core inflation, even though it obviously puts higher near-term pressure on headline inflation. But it is very hard to read.
It's very hard to read. Mike, thanks so much. Mike Bell there, of course, from JP Morgan Asset Management, stays with us, and we'll have plenty more on how you read inflation. Also, G7 ministers saying that they are ready to act swiftly to support Ukraine. That, I imagine, is through sanctions, but it could also, if you stop Nord Stream 2, put extra pressure on gas prices and therefore on inflation. The G7 putting out a communique saying that the Russian buildup at the borders is cause for grave concern. A reminder, Russia has denied that they're looking at invading Ukraine. Finance ministers are commenting in this joint email statement, but they have agreed that the sanctions would have massive and immediate impact. So it's a different tone to what we saw a couple of weeks ago, where we saw really allies fracturing. It seems that Vladimir Putin has now managed to consolidate at least the G7 finance minister to speaking with one voice. Coming up, we'll discuss what the Fed and ECB need to do to bring inflation under control. That's coming up next, and this is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's take a look at some of the events we're following throughout the week. Today, German Chancellor Olaf Scholz travels to Ukraine for talks with President Zelensky. Now, BHP and Glencore kick off the latest round of earnings from top miners when they report on Tuesday. Then it's UK CPI on Wednesday, with economists forecasting annual inflation hitting 5.5%. Then on Thursday, it's Turkey's rate decision. Consensus forecasts point to the central bank keeping interest rates unchanged. And finally, on Friday, it's French CPI for January. Now, how far and how fast should the Fed go on its fights to keep U.S. inflation under control? Bloomberg TV guests weigh in on the debate.
I think we're now in a situation where the Fed clearly needs to start hiking rates.
If you move aggressively now, you have a chance of regaining policy credibility.
If they act too aggressively or if they don't act enough, there's going to be some challenges to growth, potential for slowdown.
If they do hike by 7, which is becoming the consensus call, they may break something in the economy.
This is clearly a very hot economy, and it's the Fed's job to cool it off a bit.
The Fed should have a special meeting right now to end QE.
I wouldn't stop QE suddenly. They should have done that much early. If they do it now, the market will sense blood. They will sense that the Fed is panicking.
You can see the pressure that's building on the Fed. You can see the narrative. So it's really sort of a rock and a hard place right now.
Well, let's now get more with our guest, Mike Bell, Global Market Strategist at JP Morgan Asset Management. Mike, I mean, this is exactly what we're talking about, the fact that actually it's extremely difficult, especially on the back of this possible invasion of Ukraine, with the U.S. intelligence warning of that, to actually predict the markets or predict inflation. Let me bring you over to a chart that's a classic growth versus value chart, which I don't know even if it makes sense anymore because of this geopolitical risk. But let's bring you that and see how you would play it. Do you go into, value stocks at the moment just because of where we are in the cycle, Mike?
Well, I mean, I think energy stocks obviously benefit in a world where oil prices go higher, gas prices go higher. On the other hand, if it's going to hurt growth, then eventually that can become self-defeating, both for the oil price, but also for things like banks, some of those cyclical value stocks. So I think if we didn't have this Ukraine risk and what that could do to growth, then it would be, I think, a relatively clear-cut view that the Fed are going to still put rates up further than the market's pricing, and that tends to lead to value outperformance. But I do think the Ukraine situation complicates the trade in the short term.
But, I mean, it certainly does complicate it. Is there an assumption that the central banks could look at a policy mistake, or could you just need to trust the process?
I mean, for me, I think that if they start doing 50 basis point hikes, it starts to become a bit risky because the market then is going to find it very difficult to know what's coming in the future. So if it were me, I would look to deliver 25 basis point hikes, maybe 4 or 5 this year, see what happens to growth as a result of the higher energy prices and whether that weighs on growth in a way. And take it from there. They can always speed up if they need to.
Yeah.
But I think if they do 50 basis points, then that does risk the markets panicking that, are they going to do 50 basis points every quarter? You can get to a level that starts to become worrying a bit more quickly than is desirable.
Yeah, and I don't know whether it's groupthink in the markets, but there is definitely a concern that even ECB bets spike before the ECB even talks because inflation is higher in the U.S. Let's bring you over to the other chart, which I love. So thank you, Dan Curtis, for putting these together for us. And it's basically looking at this tighter world. You can see the ECB, the blue line right underneath your screen compared to the Bank of England in yellow and the Federal Reserve in white. And I don't know whether how you play that differential, whether it's through currencies or something else.
But for me, I guess what you're seeing is that you're not really seeing the wage growth in Europe yet.
Yeah.
So in the US and the UK, you're really seeing the wage growth come through. There's a risk that with higher energy prices that turns into a more sort of self-fulfilling cycle. But in Europe, you're not seeing that yet. Now, you are seeing some minimum wage increases, so it's possible that it could start to feed through into more broad-based wage growth in Europe, in which case, maybe that trade has further to go. But at the moment, it seems to me a little bit premature to be saying that the ECB are going to be on this sustained rate hiking cycle. It may well be that they want to take this opportunity of high inflation to get out of negative rates, because I think that was a policy mistake to go into negative rates in the first place. But once they get to zero, I think you're really going to need to see that wage growth coming through for them to want to be having a sustained hiking cycle in the way that you're going to see from the Fed and the BOE.
Mike, thank you so much. Mike Bell, the global market strategist at JP Morgan Asset Management, joining us on a pretty tricky markets day. Now, it is Valentine's Day. Up next, we talk about the dating app safe enough to take the risk. We'll be joined by the chief executive of Flutter, the first dating app to require full biometric ID verification. It launches today. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the market really falling out of bed. We have a lot of pressure because of the possible invasion of Ukraine. Certainly, that's after a U.S. intelligence report stating so. And we're seeing oil significantly higher, although now stabilizing a touch. And you can see European stocks down some 2.5% to NYMEX 93.22. Now, Flutter, the UK's first dating app to receive or require full biometric ID verification, launches today. With the aim of protecting users from fake profiles, catfishing, and romance fraud, Flutter uses AI to create a safer dating experience. Well, we're delighted to be joined on Valentine's Day by Flutter's chief executive and co-founder, Rhonda Alexander. Rhonda, what a wonderful idea. And I imagine what the uptake is. Are you expecting a lot of people to want this just to make sure that, a lot of the users are safe?
Well, as you well know, every day we see another report of some bad behavior, romance, fraud, scams that are affecting people all around the world. And it seems that the time is absolutely right for this kind of approach, which keeps people safe online.
Do you see much more of an awareness, actually, of some of the fraud that you're talking about? There was, the Hits movie that we're also seeing on Netflix. Has that changed the way that people have been using some of the dating apps?
I think so. It's definitely highlighted the abuse that's going on in the industry. I mean, it's a vibrant, thriving, growing industry, which is slated to reach almost $11 billion in the next few years. So it's very much the norm for people to be looking online to find their connections. And the news that we're seeing and the reports that are coming out more and more of people revealing some of the traumas that they've encountered, and especially with that Netflix documentary, The Tinder Swindler, it really highlights that there's a need for change.
Rhonda, what's the uptake been like? So I imagine a lot of females, because they feel safer, want to go on Flutter. Have you seen resistance from men?
Actually not. It's very much across the board. While women tend to report and reveal some of the activity that's been harmful, men are also suffering, and they are definitely the more likely targets of catfishing, for example, and terrible fraud that takes place in that way. So Flutter is for men and women across the board for all identities, and we're creating an ecosystem which is safe and empowered by biometric identity verification. You cannot enter Flutter unless you've gone through full biometric ID, and we're the first dating app that's requiring that. And we're also very much in line with the thinking regulatory wise of the online harm bill that's been introduced in the UK, and how the regulatory environment is coming up with suggestions as to how to combat this terrible abuse.
Rhonda, biometric ID technology, does it require to actually, is it a passport or is it, something else?
Our partner is a worldwide leader in digital identity called Yoti, and Yoti requires you to either give your passport or your driving license or a government certified identity verification item that enables you to set up your Yoti ID. And once you verify, you only have to do it once, and your data is only accessed by you, and Flutter does not store or sell any of our personal data for our Flutterers.
Rhonda, thank you so much. Rhonda Alexander there. Thank you so much for joining us today on Valentine's Day. Rhonda Alexander, Chief Executive and co-founder of Flutter, this new dating app launching in the UK. Now, coming up, as the UK mulls sanctions on Russian billionaire property owners, we'll discuss the outlook for prime central London real estate. That's coming up shortly. We'll have a full roundup also of your stocks to watch. The focus, of course, on Ukraine. Olaf Scholz traveling to Kiev ahead of the Putin visit tomorrow. He goes to Kiev today and then goes to Russia. Stocks falling, geopolitical risks over Ukraine rippling through global markets, oil fluctuating after some of the earlier gains, U.S. and European bond yields declining, the dollar ticking up. This is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing trading is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Diplomatic frenzy. Olaf Scholz heads to Kiev today and Moscow tomorrow. The U.S. warns an invasion may be imminent. The geopolitical risks over Ukraine ripple through global markets. European stocks fall in early trading. And a Hollywood ending for the Rams while the Los Angeles-based team win the Super Bowl after scoring a late touchdown. Well, good morning and welcome to Bloomberg Surveillance Early Edition, everyone. I'm Francine Lacqua here in London. Now let's check in on the markets because there's a lot of movement after that warning from U.S. intelligence about a possible Russian invasion of Ukraine. Stocks falling, geopolitical risks over Ukraine really rippling through global markets. Oil, we're looking at fluctuating after earlier gains, the U.S. and European bond yields declining, the dollar ticking up. Now, it's very clear that we had this U.S. warning, an invasion may be imminent. President Vladimir Putin accusing America, though, of failing to meet his demands. Russia has repeatedly denied it plans to invade its neighbor. Markets seem to just be covering their positions in case something ugly happens. But again, the uncertainty is dealing another blow to markets that are already pretty skittish about inflation and the prospect of aggressive Federal Reserve interest rate hikes to tame inflation. No, let's start with the Ukraine crisis. And President Biden's national security advisor, Jake Sullivan, says Russia could invade Ukraine at any time, despite continuing diplomatic efforts, while Moscow has repeatedly denied any plans to do so.
The way they have built up their forces, the way they have maneuvered things in place, makes it a distinct possibility that there will be major military action very soon.
We'll stay with Bloomberg Surveillance Early Edition because in the next few minutes, we'll discuss the geopolitical and markets risks with our very own Ukraine expert, Mark Champion, with Blue Bay's Timothy Ash. If you have any questions for them, IB plus TV Go. Now, after years of underperforming, prime central London house prices may see a recovery in 2022. The market, with a heavy reliance on affluent international buyers, missed out on the surging property prices seen in the rest of the UK in 2021. So could the reopening of the economy actually see prices rebound? Well, we're joined by Nicolò Barattieri. He's chief executive of the London-based luxury property developer Northacre. So Nicolò, as always, thank you so much for joining us. You always usually make us, a lot smarter on what kind of properties people want, to the price range, but also where the buyers are coming from. What's happening to Russian buyers that historically were always interested in prime London real estate?
Yeah, as you say, historically, the Russians have been very present in the super prime space. But if you look at when they were the most active, it was during the previous wave, which went from, let's say, 2009 to the peak in 2014. Since then, they have been a very small proportion of the market, which has been, which is overtaken by Asian buyers, and ultimately in the last couple of years by local owner-occupiers, where their home is a much greater focus than it was before. It's a pandemic-fueled desire to have a better home.
So who's still coming into the London prime real estate market and buying?
Look, I think international buyers have been quiet for the last 2.5 years. Previous to that, Asian buyers were a large proportion of buyers of super prime. But lately, in the last, I would say, year and a half, it's been local buyers that want a better home than they have before. And if you look at the numbers of what's happened, 2021 had 522 prime home sales. Those are classified as 5 million plus homes. That's just shy of what happened in 2013 at 533. So the market has been very strong. It's been up about 10.5% in 2021. And if you look at actually just Q4 alone had 163 prime home sales, which is an increase of about 40% in the previous quarter, and the biggest total spend ever recorded, right? Which was fueled by 20 million plus home sales.
Nicola, are you expecting international buyers to actually come into this market? And why have they been staying away? Is it because of the sanctions? Is it because geopolitical uncertainty? Or is it simply Brexit?
I think there are a number of reasons. I think that Brexit was one of them. Look, we have to remember that since the peak in 2014, we've had Brexit, we had 3 prime ministers, we had 2 changes in stamp duty, non-done changes, and a pandemic at the end. So quite a bit has been thrown to this market. But at the end, the owner-occupiers have really taken the lead in the last 2 years and have been strong. If we then couple that with potential reopening of travel in 2022, we expect a strong market. And let's say that if it's as strong as just 2021, we're happy.
Are local buyers more price sensitive, even at these very high-end properties, to international buyers?
Historically, that's very much the case. They have always been more price sensitive. But I think what is happening now is that the focus has changed from the postcode to the product. And they are very discerning. They want the best product possible. And at the end, they're willing to pay for it. So their price sensitivity is decreasing.
So how are you expecting prices in luxury central London locations to develop over the next year?
I think that there are a couple of things. I think there's strong demand on one side, but there's very limited supply. So if you look, the imbalance is greater than it has been for the last 7 or 8 years. And hence we feel that will support the market like it has in 2021. It's quite incredible to think that we've done numbers that are similar to the peak in 2013 and 2021. No one would say that that's the case, but those are just the statistics.
Nicola, I mean, there's also scarcity of timber, of workers. There's a shortage almost left, right, and center of every raw material. Does it mean that you will be building less apartments going forward?
Look, I think that development in central London going forward is going to be very challenged, right? It's challenged for several reasons. On the planning side, there are a lot of new restrictions that have come in with the new London plan that came into effect in 2019. As an example, in Westminster, you will not be able to build any more apartments that are over 200 square meters or 2,000 square feet. So that's one restriction. And then at the end, costs have gone through the roof. There's been hyperinflation in construction, but also on the lending side, it's become much more expensive. So I see that in a certain way, this vintage of developments, let's say finished between 2 years ago and the next 2 years, are literally the last hurrah of high-end residential for some time.
Nicola, thank you so much. As always, Nicola Barattieri there, the Chief Executive Officer of Northacre, talking to us about the high-end luxury market of London real estate. Now, in the meantime, we're just getting a Bloomberg News, I think it's a Bloomberg scoop, HSBC to double some of the junior banker bonuses in the race for talent. Now, the lender, which pays less than most rivals a year ago, or they were one of the ones that paid the less a year ago after cutting the bonus pool at its global banking markets division by 15%. We understand now wants to avoid losing junior staff to Wall Street firms who have been consistently raising pay. Now, this is according to people familiar with the matter that have been speaking to our Harry, Denise, and Aberreen. And more senior employees are also said to be in line for 2021 bonus hikes of at least 10%. So I don't know whether this is inflationary overall, or this is just playing catch up with some of the Wall Street banks. Coming up, tense diplomacy. President Biden promises a swift response if Russia invades Ukraine. Crude rallies pushing towards $100 a barrel. That story's up next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think time is of the essence for a company like ours to make its transformation. We've been an international oil company for 112 years. We want to transform ourselves into an integrated energy company. It's what society wants and needs. It's what our staff and employees want and need. And ultimately, we will prove that it's what our shareholders need. So we needed to crack on. We needed to press on. There is an emergency happening around us, and in many ways we can't wait. And that's why we decided to do it. And I feel it was the right decision.
I mean, what do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Well, that was the BP Chief Executive, Bernard Ludy, and you can catch that full conversation on Leaders with Lacroix. That's airing later this month on Bloomberg TV and Bloomberg.com. Now, let's get back to the latest on the Ukraine tensions. Joining us now is Bloomberg's senior reporter for international affairs, Mark Champion, who's been covering international affairs for major media outlets for decades. He's just also returned from Ukraine. Also joining us, Blue Bay Asset Management's Timothy Anch, one of the foremost experts when it comes to Russia. So thank you both for joining us. First of all, Mark, how, as an investor, how, as a geopolitical watcher, do we measure what do we think Vladimir Putin will do? I mean, this feels like the most difficult question of the decade.
I think that's probably about right. I mean, my basic sense about this is that, for people who think that they know that he won't go in, they probably don't. And that people are absolutely sure of how he will go in or when he will go in, they probably don't. And you can see that uncertainty roiling markets right now. Probably they've been a little too calm until now, but we're now at that point. The stuff, the Russian technical troops, the personnel, they're all in place. So it could happen any day, or it could not happen. But we really don't still know.
Tim, do you think Vladimir Putin wants to invade, or does he want to inflict chaos and uncertainty, which he's doing right now?
Well, it's difficult to predict whether or not he's actually going to go in, as Mark said. But I think what we do know is the status quo does not work for Putin, right? I mean, he's gone through the Minsk process, the Normandy peace, etc. He hasn't got what he wanted. So, this is all about changing the narrative, trying to shake things up a little bit and push things on. And so that's the risk. The status quo is not working. He needs to do something different. Does he need to escalate? Well, we'll find out in the next few weeks, I guess.
Timothy, we also know that Russia says that they have a very strong economy to be able to deal with any kind of sanction or also, this invasion of Ukraine. Is that true?
Well, it is. I mean, you look, 630 billion reserves, FX reserves, very little debt, less than 20%, public sector debt. External debt also is not huge. But, the kind of sanctions that the Americans are talking about, and I do believe them this time, because I think for this administration, at least it's important to remember, they weren't really interested in Russia and Ukraine, right? They wanted to focus on China. But this crisis has hit, and I think people like Jake Sullivan, et cetera, have realized that actually if they're going to stop China over Taiwan, they have to stop Putin over Ukraine. So that's why I think we're going to see very aggressive sanctions this time, and they will hurt Russia, undoubtedly. Sanctions have had an impact. They've stalled growth. They've made Russia a very stagnant economy. Great balance sheet, but no growth.
Yeah. Mark, I mean, something that struck me is Emmanuel Macron coming back to France and saying this is a different Vladimir Putin, a much harder Vladimir Putin, a more calculated, less friendly president of Russia. What does it mean for diplomacy? Olaf Scholz is going there tomorrow. Today he's in Kiev. I mean, do we just put a stop to diplomacy altogether?
Well, you can't put a stop to diplomacy. I mean, this will be like a last-ditch effort. There will be, there may be more last-ditch efforts depending on what Putin wants to do. I think it's true. Putin's always been a tough character. I think Macron's got, slightly rose-tinted glasses about the past. When you're thinking about this, you think back to the Crimea, you think back to Georgia, and so on. This is a tough president. But he is really, the warpath is the wrong, phrase to use right now. But he is. He's on the warpath. As Tim said, he wants to change the story. And there is the interesting thing to me is that when you speak to people who are, closer to the Kremlin, they'll say that they don't know what he's going to do, but they will say that, we've already had a success. Already in the West, people are talking about, do we really need NATO expansion, for example? Yeah. NATO is a subject for discussion in the way that it wasn't before. The question we don't know is what does Putin need in terms of a level of success, and how long is his plan to get what he wants?
Timothy, what do you think could deter, at this point, Vladimir Putin? There was a pretty tough editorial by Ann Applebaum in The Atlantic saying, look, we need to go hard, expel people, but also make sure that the kids that go to private school in Switzerland and the UK are thrown out. Maybe that will get Russia's attention.
Well, I slightly disagree with Mark. I mean, I think he hasn't achieved very much so far, because what he's achieved is, I think NATO's more unified. There's more direction of purpose than we've seen in a decade, and Ukraine has been rearmed. And I've always thought this is not really about NATO, it's about Ukraine. Putin wants to bring Ukraine back under Russia's geopolitical orbit. He's not happy about the fact that Ukraine is building a defensive capability. And the rearmament of Ukraine we've seen in the last couple of weeks just plays against Putin. So I'm not sure he's really winning. And that's the problem. He's not got very much from what he's done so far. He doesn't like the status quo, so what's he going to do next?
Yeah, no, I don't disagree. I mean, the point there is that as it's sometimes put, there are various things we want, but the first thing we need is the political. The political is these, the concession on NATO. But I would agree with Tim. This is ultimately about Ukraine. Yeah. That is what NATO expansion is mostly about. But it isn't even just about NATO expansion. It's also about the EU expansion. This all began with a trade deal, after all, not NATO. So yeah. It's a big agenda that Putin has.
Tim, I know it's difficult, but are we at 50-50, the chances that actually he invades Ukraine also because he wants to spur that nationalism back home?
Well, I've been pretty vocal in what I think, and I think the messaging from the U.S. administration that didn't want a conflict with Russia. Just again, go back to that. I mean, there's a lot of stuff out there saying that this is warmongering by the Biden administration. They didn't want a crisis with Russia over Ukraine, right? They wanted to focus on China. They have no interest particularly, or they had no interest in providing all this really detailed intelligence about what the Russians may or may not be doing, right? But I think it's stark, what we're seeing on the ground. And on the balance of probability, the risks are certainly, in my mind, it's about, again, Putin's not getting wanted. States he doesn't like the status quo. He's more likely to escalate than de-escalate.
Timothy, very quickly. I mean, I know there's, of course, they have palladium, they have wheat. How does that, if there is an invasion, as an investment manager, like, do you run for the hills, or how do you play this?
It's hard to be too clever in this scenario, right? I mean, just read what our governments are telling us, right? And that would suggest you need to be very, very cautious about Russia and Ukraine risk.
All right, thank you both for joining us. Bloomberg Smart Champion and Blue Bay Asset Management's Timothy Ash. Now let's get to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Francine. Clarion shares have plunged after it delayed publishing its results and started an investigation into its accounting. This comes after internal whistleblowers said it may have incorrectly booked provisions and accruals. The Swiss chemicals company says it may need to restate results for 2020 and for the first half of this year. Now, sources tell us Apple is boosting pay for its US retail workers as it navigates a tight labor market. Rises of between 2 to 10% have been offered to some salespeople and Genius Bar tech support staff. It comes after Apple revealed plans to offer part-time staff paid vacation for the very first time, as well as more sick days and childcare benefits. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up, it was a closely fought win for the LA Rams in this year's Super Bowl, but the new stars off the field are cryptocurrency exchanges. What a halftime performance. That story's up next. This is Bloomberg.
announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We still see inflation moderating in the next year. It is very unlikely that we will raise interest rates in the year 2022. That still stands. I can tell you that there was unanimous concern around the table of the Governing Council about inflation numbers.
It's a regime change, but as you can see, a lot of it is already there, priced in the markets.
The bond market, I think right now it's unpleasant because the regime has shifted. People getting used to it. You know, not long ago, central bankers were telling us we're not going to raise rates at all.
People are beginning to price in finally, getting out of negative policy rates in Europe.
The reality is they haven't hiked rates and they still need to go.
As we've seen in the peripheral bonds in Europe, that can be pretty unpleasant.
About 2 years ago, I sent an email out saying we think 10-year bond is going to go positive. 3 of my largest contacts in the industry, they insulted me.
So I think at every level we're in a kind of a new regime, and you can see this. The market is trying to find its way.
Well, that was ECB President Christine Lagarde in reactions to her shift in position on inflation. Now, the Super Bowl. The Los Angeles Rams beat the Cincinnati Bengals 23-20. Rams wide receiver Cooper Kupp was named MVP after landing the winning touchdown. But the big stars off the field this year have been ads featuring crypto exchanges and other financial services companies. This ad by FTX Trading, for instance, featured comedian Larry David. Well, joining us now for more on all of this is our Bloomberg Quick Take correspondent Alex Webb. Alex, I have to say it was really the halftime show that took it for me. Eminem, Dr. Dre, Snoop Dogg, and Mary J. Blige. But what is amazing is the numbers going through in terms of advertising. Why is it still such a big deal? It's like the temple of advertising worldwide.
Well, this year, for one, there's going to be a sort of growing audience, which is not something we've seen in quite some time. But even when audiences were declining, the value of ads at the Super Bowl also increased. And that's partly because you are not getting the same audiences to live TV during the week. You don't have 25 million people watching Friends of a Thursday. Instead, you get a few tentpole big sporting events, so that even if the smaller audience is there, they're more passionate, more likely to stick around, and they therefore bring value in terms of for the advertisers.
So what about crypto exchanges? Is this desperation trying to become more mainstream, or does this make them more mainstream?
It's about making them mainstream. Firstly, there are a couple of different ones competing for market share. We don't quite have a dominant one yet. There are some obviously big ones out there, but they're fighting to be the dominant position. When that happens, when mobile phones were new, or mobile phone companies were new in the 90s, they were all piling into sports advertising. At the moment, you're seeing a similar thing with crypto, but they're also trying to broaden the investor base. They need the new wave of investors to keep prices going up, and so that's why you attack this massive address this massive audience to try to get them into crypto investing.
Alex, thank you so much. Alex Webb there looking at the advertising surrounding the Super Bowl. Now, this is what the markets are doing. A lot of pressure because of Ukraine. Our Anna Edwards will be going through the big moves with Matt Miller and Cable Lines. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
The Fed clearly needs to start hiking rates and probably not shock therapy, definitely not shock therapy.
Higher prices causing inflation. It's not in the interest of consumers, but not in the interest of producers either.
I feel that our job is to make sure that the energy is there as best as possible, as much of it as possible.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kayleigh Lyons.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. On this Monday, February 14th, our top stories today. Tensions build. The U.S.-Russia standoff over Ukraine has entered a potentially decisive week. The U.S. warns an invasion may be imminent. The geopolitical risks ripple through global markets. European stocks and U.S. futures fall as oil reverses earlier gains. And crypto makes its Super Bowl debut. Coinbase may have scored big in Sunday's ad blitz. Welcome to Bloomberg Surveillance, everyone. This is the early edition. I'm Danny Berger in London with Matt Miller and Kayleigh Lyons, both in New York. Anna Edwards is off today. And Kayleigh, I have no doubt that some folks watching this program probably have yet to sleep since the Rams clinched the victory yesterday, but they better be awake, shaping up to be a rough day in markets.
Yeah, congratulations to anyone who made it through the whole Super Bowl and also is up at this hour. I only made it through the halftime show, which was amazing, by the way. Now, overnight, there was a lot to pay attention to in Asia. Broadly, a down day for stocks. The MSCI Asia Pacific Index as a whole was off by about 1.4%. All the major regional benchmarks lower. A big underperformer was Japan. The Nikkei 225 down 2.25%. Actually saw its volatility jumping to the highest since back in December. Really, stocks in Japan and in the Asia region more broadly playing catch up to the big losses we saw in the U.S. on Friday. Of course, we have geopolitics with Russia and Ukraine, inflation, and the reaction from central banks really front and center in terms of what the market is worried about. While Japanese stocks were lower, though, you did see a bid coming into the safe haven Japanese yen, a big outperformer in Asia, and G10FX stronger against the dollar by more than 1/3%. 115.03 is where we sit. And you also saw that safe haven bid coming into the bond market in Australia. The 10-year yield down 7 basis points to 2.138, Matt. So you're seeing a bid into bonds, but of course what we saw in Australia probably playing up to that big bid in treasuries we saw on Friday.
Yeah, all right, let's take a look at what we're dealing with this morning here in terms of the U.S. Futures down more than 1%. Remember, we had a 2% drop in the cash trade on Friday. So the geopolitical tensions really ramping up and giving investors jitters. The 10-year yield right now coming down a little bit as investors buy into the perceived safety of government debt. And I've got to look at some safe havens in just a moment, but clearly the 10-year yield is one of those places that investors go to hide. NYMEX crude coming down, can't hold on to the highs, but we're still at $92.85 a barrel, 94 for Brent crude. So we're still up there, but we're coming off a little bit. Bitcoin coming off a little at $41,968 as well, even after all of those crypto commercials at the Super Bowl yesterday. Now check out the traditional safe havens. The dollar is clearly one, and we see a little little bit of a bid for the Bloomberg Dollar Index today. The Swiss franc, which is here, and the Japanese yen, which are here, these are dollars priced in Swiss francs, dollars priced in Japanese yen. So as a result, when the franc rises in strength against the dollar or the yen rises in strength against the dollar, you'll see red arrows here coming down. So right now, a U.S. dollar can only buy 92 centimes. Right now, a U.S. dollar can only buy 115 yen. That means people are going into those safe haven assets. Gold coming off a little bit, but still relatively unchanged at 1857, 1858. So a pretty high number for gold as compared to what we've seen historically. Danny, what do you see in European markets?
More red on the board, Matt. There's not a single European regional benchmark that is pushing positive today. Losses more than 3% in some regions. At first, it did seem like this was a catch-up to the U.S. trade, but as we went from the futures market to the open of cash equity trading in Europe, the losses started to pile, especially those regions exposed to Eastern Europe, exposed to the geopolitical tensions, suggesting that something else is afoot here, that something else being, of course, the risk of geopolitics. Let me show you what Russia stocks are doing, down 3.3% this morning. Again, this is where all of the tensions are filtering through this market, not just in equities, but in bonds as well. We're getting a bid similar to what we saw on Friday. That session, this move into haven assets, that playing through in bonds. We're looking at the bund yield, 0.2. It wasn't that long ago we were talking about this turning positive for the first time in quite a bit and celebrating that, but there are places along the German curve that are now falling back negative, again, because we are buying that. Similarly, we're looking at a UK 2s 5s curve that has inverted. Now, this key is a bull flattening. This is a bid across the yield for UK markets, but a higher bid on the long end of the curve for that perceived safety. So we had seen bear flattening with concerns about central banks. It's different today. And finally, Kaylee, natural gas up 7%. At one point today had been up 14%. It's still about 100 euros below where the peak was, but it's clear with Russia having most of the natural gas, with a lot of that, about a third of it flowing through Ukraine, this is a place where we're seeing those geopolitical tensions also play out this morning.
Yeah, we will be paying attention to the entire commodity complex throughout the day and probably throughout the coming days, Danny. Now, what else are we paying attention to in the coming days? A look at what is ahead this week. Later on today, ECB President Christine Lagarde is due to address the European Parliament on the central bank's annual report. Anything she says, I'm sure, will be very closely watched by the market. Then on geopolitics, German Chancellor Olaf Scholz will travel to Ukraine today. Then that will be followed up by Russia tomorrow. We'll also get U.S. retail sales and the Fed minutes on Wednesday. And then G20 finance ministers and central bankers will meet in Jakarta on Thursday and Friday. And finally, we'll get a host of Fed officials speaking throughout the week. Those will include Bullard, Mester, Evans, and Brainerd. It'll be interesting to see how they react to the really hot inflation data we got last week, Matt.
Yeah, absolutely. And being driven higher, obviously, with energy prices as tensions over Ukraine are at a fever pitch. A Saturday phone call between Presidents Biden and Putin failed to move the needle. Yesterday, U.S. National Security Advisor Jake Sullivan warned about the rising risk that Russia will attack or seek to ignite conflict within Ukraine this week.
The way they have built up their forces, the way they have maneuvered things in place, makes it a distinct possibility that there will be major military action very soon.
Now, Russia has repeatedly denied that it plans to invade Ukraine. That's important to point out. Joining us now is Anne-Marie Horton out of D.C., Bloomberg's Washington correspondent. With us in Brussels is our European correspondent, Maria Tadeo. Anne-Marie, let's start with the latest developments out of Washington. What do we know?
Well, the high-stakes phone call on Saturday was really where all the focus was. This was between President Biden and President Putin, and it just yielded no results. There was zero breakthrough, and it was very inconclusive. When you were on the press calls, both in Washington and Moscow, following that report, both sides really stuck to their main talking points. The United States saying, and indeed an attack could potentially happen at any time, and there would be swift and severe economic consequences. And then in Moscow, the press call was really about how Putin was saying that the U.S., quote, hysteria over Ukraine had reached a peak. There's one headline, though, that stood out for me from both capitals, and that is the fact that President Biden and President Putin both agreed that their teams would stay in touch and engaged.
And in terms of the deterrence here. The president has repeatedly warned of these, repercussions for Russia. Do we actually have a consensus on what potential sanctions would look like, given some of the conflicting concerns from U.S. allies?
Well, each country would go about the sanctions package on their own, but there is this unified front, and you can hear that across really the capitals in Europe. Scholz was just tweeting about it as he's making his way to Kiev and then to Moscow, that they would be united in severe economic sanctions following that. The U.S. has been working for weeks to make sure they could shore up their allies, even some that are very heavily dependent on Russia, that they would form in line. What you're seeing now, though, in the United States, of course, is the fact that in Congress, that harsh economic sanctions package has yet to cross the finish line. Republicans and Democrats are still debating how much they should put on Russia in terms of penalties immediately and how much should be actually pure deterrent factors.
Anne-Marie, thanks so much. That's Bloomberg's Anne-Marie Horder giving us the view from Washington. Now let's get to the view from Europe. Maria Tadeo again joins us in Brussels. So Maria, we have German Chancellor Olaf Scholz in Ukraine today, Moscow tomorrow. Given the inconclusivity that we heard from Washington that Anne-Marie was describing, what can be accomplished with Scholz visits?
Well, Danny, this is a huge test for Olaf Scholz. This is a first-time chancellor who is coming from the SPD, the Social Democrats. They have been hugely under fire for their, at times, confusing relationships with Russia and the Russian political elite. And he will have to send a clear message to Vladimir Putin tomorrow. The Germany this time around means business. Now, there's two things, of course, that will be top of the agenda. One is just how much economic pain Germany is willing to withstand to send along with this political message. And then tomorrow, of course, this is the first time the two will meet face to face. This is a very different scenario to Angela Merkel, who is a fluent Russian speaker, and he will have to tell Vladimir Putin to his face whether or not the Nord Stream 2 pipeline gets canceled. Until now, there has been a lot of ambiguity in terms of what happens to that pipeline, and there is growing pressure, not just in Germany, but also in the European Union, that this time Germany really has to send a very, very clear signal. We're talking about potentially a war breaking out an hour away from Berlin.
Yeah, and of course, not only would Nord Stream 2 be canceled, but the pipeline that runs through Ukraine, which delivers over a third of European energy needs, would likely have difficulty maintaining operations. So what does this mean for Europe in terms of getting its energy?
Well, Matt, is a very good point, because we're talking about Nord Stream 2, but we also have to talk about Nord Stream 1, which is operational. And then, of course, you have to talk about the situation through Ukraine. Ukraine does not use Russian gas, but it is a huge transit nation. And remember, by the way, last year when President Biden and Angela Merkel had a meeting over the summer, she agreed that Germany would continue to pay Ukraine so it wouldn't suffer financially from Nord Stream 2. So again, you could see supply becoming tighter even more so. But also, Matt, when you look at this, you do see that every scenario on the table for the German government is just so bad. If they cancel the thing, they could face litigation. This is already done. If they don't, they still have to pay Ukraine and be still reliant and dependent on Vladimir Putin. So it's not an easy answer for Olaf Scholz here. It's a very difficult situation for them.
Yeah, potentially a lose-lose situation. Bloomberg's Maria Tadeo in Brussels. Thank you so much. Meanwhile, oil is fluctuating amid concerns Russian energy supply might be disrupted. Kriti Gupta, Bloomberg Markets correspondent, joins us now. So Kriti, roughly flat at the moment, but still a 94 handle on Brent. Could $100 oil become a reality due to these tensions?
Yeah, it absolutely could. And you're already seeing it kind of play out earlier in the session. You saw Brent crude hit that $96 a barrel peak target. What's interesting here is that it's not just the geopolitical tensions that are at play. Yes, of course, we know that Russia and Ukraine and the Western allies are, of course, at odds, and that is creating this kind of geopolitical premium baked into prices. But remember, Russia is also behind when it comes to supplying oil supply simply as part of its OPEC plus target. So it's simply because of a lack of investment that they did last summer, and then the weather really prohibiting them from being able to ramp up supply in the way that perhaps Saudi Arabia or the UAE has. So it absolutely is hitting those levels. That being said, you are also seeing volatility on the other side as well. So you can actually note that Brent crude is back down to a 94 handle now. And the reason for that is because crude is also a risk asset. So when you see these oil prices kind of fluctuate, you're seeing essentially a tug of war. On the one hand, hand, you have these geopolitical tensions, specifically driven by Russia's supply and what sanctions might mean for simply the pricing that does happen in dollars. But the other side of the equation is simply that oil does actually move with stocks. It moves with risk assets. It is kind of this proxy for global growth. And right now, you do have this kind of risk-off sentiment throughout the day in stocks, in Bitcoin, in currencies as well. And that, of course, is pulling oil lower as well.
And oil at these levels, of course, is difficult for the Fed because this just aggravates the inflation they're already dealing with. Senator Joe Manchin of West Virginia yesterday said the Federal Reserve needs to stop pussyfooting around. His words, he said they need to tackle inflation head on. Again, that's his phrase. He really wants the Fed to come out and do something, and he's not alone.
Yeah, he's not alone. What's interesting here is that the Fed is really kind of stuck in between a rock and a hard place, and the best example is Treasuries right now, because at the end of the day, it remains a safe haven asset. It remains that geopolitical risk where you start to see funds flowing into the U.S. Treasury market. On any headlines, the U.S. yield will go down even in the face of a hawkish Fed. So right now, the Fed, and when it comes to the bond market, you really are once again seeing that tug of war. Do you trade that geopolitical risk in the short term, or do you trade that longer term kind of hawkish pivot? And that's really where people are comparing this to Greenspan's policies going back to 1994. The idea that such aggressive tightening has to take place. You did see the bond market, those 10-year yields rise, I think about 286 basis points between 1993 and 1995, early 1995. And we are already seeing a much bigger reversal this time around. The question is, how does that geopolitical pricing play into that?
All right, Kriti Gupta, thank you so much. Now, Matt and Danny, we've talked about the markets, we've talked about geopolitics. We also have to talk about that little game that happened yesterday. I think I'm the only one that watched it because it was past most of our bedtimes. I have to say, it was a really good first half, didn't catch the second half, but the Rams 23-20, topping Joe Burrow and the Bengals. Cooper Kupp with the game-winning touchdown, getting that MVP. And of course, the commercials, also something we were paying attention to, Matt.
Yeah, I would love to watch the game. We'll probably do later this afternoon. Obviously, I had to go to bed, but I did watch some of the commercials. I especially love Larry David doing the FTX crypto commercial, but crypto was huge, right?
It was huge. You know what else was huge? This is why the American consumer sentiment surveys have fallen so much. Beer was $17 a pop. Kaylee, that is some painful inflation to face at the Super Bowl.
Yeah. Well, if you're lucky enough to get a ticket to the Super Bowl, I think it's probably fine. Now, what's interesting is, of course, you would expect that some betting stocks would be doing well. They were doing really well last week leading up to the game, but that is not the case, actually, when you look at pre-market trading. DraftKings, one of the big ones, of course, is actually moving lower. It's down by about 2%, so giving back some of those gains, but of course, it is a broad risk-off day. There's only a handful of stocks actually in positive territory in early hours this morning. One that is in positive territory, though, is Splunk. This is after the weekend it was reported that Cisco Systems was potentially looking at a $20 billion takeover of the company. Those talks apparently failed, so that deal is not happening. Still, though, that stock is up about 3% in early hours. And finally, Lockheed Martin is also a little bit higher. One of its deals had faced pushback from the FTC because it may hurt competition within the aerospace space. So it's not having to pay $4.4 billion for that company. So it's up about 0.5% in early hours, Danny.
Kaylee, I fear that some of this negativity in markets has to do that we all wore shades of red for Valentine's Day today. I fear that we might have cursed it a little bit. All right, well, on a more serious note, coming up, we're going to be speaking to Ed Clissold, Ned Davis, Chief U.S. Strategist, about the red we're seeing throughout markets. How do you position as geopolitics fears filter through? And oil growing increasingly volatile amid tensions in Ukraine. More on the energy story ahead. Plus, the real winner of the Super Bowl. We're going to discuss the ads that scored big. This is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kayleigh Lyons here in New York. Danny Berger filling in for Anna Edwards over in London. Now, we are watching energy very closely as the Russia-Ukraine tensions continue to heat up. I've got a chart here that shows Brent's dated to frontline swaps. Now, this is the difference between the nearest futures contract and the price of an actual barrel of oil, and it has surged to a record high right now, showing that buyers are finding it difficult to get hold of the physical commodity. Joining us now is Will Kennedy, Bloomberg Executive Editor for Energy and Commodities out of London. Will, what's going on here? I mean, it's not just the geopolitical tensions, but there seems to be a supply problem.
The market is extremely tight, and the chart that you're showing there, Matt, is telling us that the market is extremely tight. Traders want oil, and they want oil in the short term, and they're willing to pay a premium to get it, as you point out there. So what we have right now is a mixture of very strong supply-demand fundamentals. Demand is recovering very strongly. Supply is probably lagging to some extent. We've talked extensively about how OPEC Plus production isn't meeting its commitments. Stockpiles around the world are declining. And on top of that, you're layering this extreme geopolitical tension involving the world's second largest oil exporter, Russia. And it's a pretty bullish mix.
Super backwardation, not going anywhere. Will, thank you so much for the update. That's Bloomberg's Will Kennedy on all things oil. Speaking of which, later today, we're going to be speaking with Citigroup Global Head of Commodities Research, Ed Morris. That's at 10:30 a.m. in New York, 3:30 p.m. in London. More on these markets next. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year, and I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Time now for the First Word News. And the Ambassador Bridge that links Ontario with the U.S. has reopened after a 5-day protest against vaccine mandates stopped traffic. Authorities started clearing demonstrators on Saturday before working to remove barriers erected at the site. The protest halted the movement of goods worth almost $14 million an hour. Hong Kong's daily virus cases topped 2,000 for the first time ever, with the worsening outbreak threatening the city's COVID-0 push. Health authorities also announced 4,500 preliminary infections. Cases have exceeded capacity at Hong Kong's hospitals, and officials have asked for Beijing's support, including help with its test kit supply. And HSBC plans to as much as double bonuses for some of its junior investment bankers and traders. It reportedly wants to avoid losing junior staff to rival Wall Street firms who have been upping pay. More senior employees are said to be in line for bonus hikes of at least 10%. But coming up, we'll get back to the markets. A very risk-off day is taking shape with geopolitical tensions front and center, as well as inflation and the monetary policy response. We'll discuss it all with Ed Clissold, Ned Davis, chief U.S. strategist, why he has turned away from U.S. stocks. We'll get his take on where you should be positioned in this kind of environment. This is Bloomberg.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition. Here's what you need to know. President Joe Biden told Ukraine's leader on Sunday that the U.S. and its allies would act swiftly and decisively if Russia were to invade Ukraine, echoing comments he made on a Saturday call with Russia's Vladimir Putin. The U.S. says an invasion may be imminent, while Russia has repeatedly said it has no plans to invade. German Chancellor Olaf Scholz is set to meet with Putin in Moscow today. San Francisco Fed President Mary Daly is calling for the rate hike path to be data-dependent and measure. Daly told CBS that abrupt and aggressive action can be destabilizing. Meanwhile, U.S. Senator Joe Manchin told the Fed it needs to, quote, stop pussyfooting around and tackle inflation head-on. And the Los Angeles Rams beat the Cincinnati Bengals 23-20 to win the Super Bowl on Sunday. The victory gives the Rams their second ever Super Bowl title and their first as a team based in Los Angeles. Crypto also made its Super Bowl debut. Coinbase may be the biggest winner in Sunday's ad blitz. I'm Danny Berger in London, filling in for Anna Edwards with Matt Miller and Kaylee Lyons in New York. And Matt, yes, we're all just shaking off the Super Bowl hangover this morning, but it is turning out to be quite an ugly day when it comes to this trading session.
Yeah, absolutely. I mean, I obviously didn't stay up to watch the Super Bowl, but I did watch futures this morning starting around 3 o'clock. We're down significantly right now, 9/10% after the big drop that we saw on Friday. We were down almost 2% on Friday, so we're off more than 7% year to date for the benchmark index, and it looks like it's going to fall further on geopolitical tensions today. One of the places investors are hiding is bonds. We see the 10-year yield now coming down. It's still at a relatively high level, 191.29, but it's off as investors seek safety there. NYMEX crude now turning higher. It had been off a little bit this morning, going back up, and you can see $93.22 a barrel. That's not Brent, that's WTI, so it's a pretty high quote here. Bitcoin off just a little bit, even after all those crypto commercials, 42,146. I've got to be honest, I woke up this morning, Kaylee, and I thought Bitcoin would be up because of so much hype yesterday.
Right.
I thought there'd be a lot of retail buying, but it doesn't look like that's the case.
Yeah, I thought so too, Matt. Coinbase, for example, which had the commercial that was one of the most buzziest with that QR code that was just bouncing around the screen. I, a journalist who was naturally curious, did scan it to see what it was, and it was for Coinbase, but Coinbase actually isn't trading in pre-market. A lot of other stocks are, though, and almost all of them are to the downside. Among companies worth $5 billion or more, only 12 of them are higher in early hours. For $25 billion or more, only 4 of those companies are in the green. A lot of others in the red, and it really is across sectors. Vaccine makers like Novavax down 2%. You also have a lot of the travel complex under pressure. Carnival's down about 2.3%. Some of those more lofty values like Tesla are also lower. And then even oil, we were talking about that story. Oil has been bouncing around. Even ExxonMobil is down about 0.9%. So a broad risk-off day here in the U.S. when it comes to individual names, Danny.
the losses in Europe, Kaylee, are more steep than that, and that just does show you the geopolitical tension, where it's getting priced in, and how it's being felt most acutely. The DAX, for example, down more than 3%. We can see Russia stocks down more than 3% as well. So anything with the Eastern Europe type exposure taking a hit today, much like you were pointing at, Matt. Throughout Europe, we're buying into that perceived safety of bonds. We're looking at a 10-year German bond yield that's down 8 basis points. We're on track for the biggest decline in the 10-year bond yield since the start of the pandemic. So again, it's that bid into safety, of course, this time for a much different reason. You're also seeing it in the United Kingdom, where the 5s-7s curve has, or rather the 2s-5s curve have inverted. Now, it's not because of BOE bond buying. It is a bull flattening. In other words, everybody is buying bonds across the board. They're just doing so more acutely in the long end of the curve. So that is causing this to invert, going negative. And finally, natural gas down 4.5%. Russia, of course, supplies most of the nat gas. A third of it flows through Ukraine. So naturally, concerns about supply sending that higher, Kaylee.
All right, Danny. Well, let's talk more about these markets. Ed Klissel, Chief U.S. Strategist for Ned Davis Research Group, is joining us now. Ed, of course, one thing that is really in focus today is geopolitical risk. And I want to point to the research just out of Morgan Stanley. Mike Wilson and the team writing that a war materially increases the odds of a polar vortex, he calls it, for the economy and earnings. A spike in energy prices would destroy demand and, in our view, and perhaps tip several economies into outright recession. I'm wondering how you view these geopolitical risks, Ed, and whether or not that could potentially become a reality.
Well, yeah, I think there's two things to consider when you're talking about these geopolitical risks. The first is the sentiment reaction. And we've done studies going back several decades looking at these crisis events. And usually the market reacts negatively first, down about 3% during the crisis itself for the S&P 500, but then you recover that over the next 1 to 3 months. Usually the market, doesn't like the uncertainty, and once that's the bad news is out there, then the market can move forward. But the other aspect is where we are in the cycle, with the Fed obviously starting to tighten most likely in March, and they're ratcheting up how many hikes they're going to do this year. And then the earnings cycle is also at a phase that's less favorable for the market, where earnings are going to decelerate from about 65% growth in 2021 to right now consensus is around 8% for 2022. We're taking the under on that earnings growth because margins are already very high, and then you throw on some higher costs in there, margins will get hit even more. So that is certainly a risk for the market.
So, 8% wouldn't be bad, but less would, I think, disappoint the market. Do you agree that the inflation is really the problem for corporate earnings this year?
Well, yeah, so if you take a historical view of it, in the third year of an expansion, usually margins are continuing to rise. But because companies did such a great job so far this cycle, margins have already recovered to previous highs and well past them. So it's going to be hard for them to continue to get margin improvement. And then you throw on some higher costs, not only from energy prices, but of course wages, which are the biggest input for most companies. And we don't think margins are going to get crushed. It only happens during recessions, but a little bit of downward margin pressure on the back of already decelerating earnings could get us close to zero earnings growth for the year. And that, I think, would be a pretty big surprise for the market.
But to be clear, Ed, you're not bearish 2022, right? I mean, you are neutral this year. What does that mean for your strategy? Where do you put your money if you have dry powder?
Yeah, so we're on an absolute basis for the S&P 500. That's neutral. Neutral means 5 to 7% return for the year. Our thought coming into the year was to be a weak first half, maybe a little bit better second half. That's how it's setting up as of right now. But from an allocation standpoint, we've ratcheted down our equity allocation, although we still are modestly overweight. 55% is our benchmark for stocks. We're at 60, and we've gone up in cash, and we're underweight bonds. Now, usually the way these corrections take place is, first of all, the bonds get hit on inflation concerns, but then it will become more risk off. So if we were to make additional moves out of stocks, it might actually be more into bonds and less into cash because it can become more of a true risk off move. That's not what we've done up to this point, though.
Ed, how nimble do investors need to be in this volatile period and have cash at the ready to deploy should there be opportunities?
Yeah, cash really is something that most investors have tried to shun because it was yielding basically nothing on a real basis negative. But now is a time to have some in your portfolio, some dry powder, because double dip recessions or recessions within a few years of each other are very rare in the U.S. Only one in the last 70 years. That was 82. So if it's not a recession, the decline in the market tends to be limited. Around 7 months, about 20% is the average. So that, don't write that in stone. That's the average. But that would mean that have some dry powder to deployed maybe around mid-year when some of these concerns are lifted. And if the market is down quite a bit, then I would expect the Fed would at least start to ratchet back on their rate hikes, and that could provide some relief for the market as well.
Okay, so maybe somewhat of a Fed put would kick in, Ed. On the subject of the Fed, a headline just crossing from the Wall Street Journal that Esther George, the Kansas City Fed president, said they may need to actually start selling bonds from that $9 trillion balance sheet in order to curb inflation. So not just letting them run off, but actual outright asset sales. I'm wondering how you view the Fed's different policy tools, not just the hiking mechanism, but also running off and potentially starting to sell assets off that balance sheet, and what the influence would be on this market.
Yeah, if the Fed were to ask me what to do, I would say I'd focus a little bit more on QT and less on rate hikes to avoid flattening the curve. And you could do that, using their mortgage-backed securities, which, we have to wonder with the housing market as hot as it is, why are they still buying mortgage-backed securities? So that would be one way to go, and would be probably something that the market would react a little bit more favorably to than maybe, hiking every single meeting or throwing in some 50 basis point hikes, which has been floated out there.
Ed, thank you so much. Great to get your insight today. Good luck on today's markets with this volatile day that's shaping up to be. Ed Klissel, Chief U.S. Strategist for Ned Davis Research Group. Now, coming up, Sunday night's big winner. We're on crypto's Ad Blitz next. This is Bloomberg.
This is Bloomberg Surveillance, simulcast on radio and television. I'm Matt Miller with Kaylee Lyons in New York, Danny Berger in London. Now, crypto made its big debut yesterday during the Super Bowl, with advertising spots being bought by the likes of FTX and Crypto.com. The big winner of the evening may have been Coinbase. The 60-second promo seen here featured a bouncing QR code that directed viewers to the company's website. The ad was so popular it crashed Coinbase's website. So I guess a lot of people actually did. If you could figure out how to do it, take a picture, I guess, of the QR code, and then, or do you have to have a QR reader? I don't know, I'm too old. Joining us now is Paul Sweeney. He co-hosts Bloomberg Markets with me on the radio, and he also helped create our investment research practice, Bloomberg Intelligence. Paul, of course, you have years of experience on Wall Street as well, covering the media. What did you think about, I mean, yesterday was big, not only because it was a Super Bowl, and there were teams that aren't normally in the Super Bowl, and betting is legal, and crypto is buying ads. What were your thoughts?
It was a heck of a day for NBC, for Comcast that owns NBC. I mean, they started the day at noon East Coast time. The game didn't begin until 6:30, so they had all that time and all that programming. And so it was a great game, which is, you know, first and foremost. And so if you bought an ad in the first quarter, you were happy. If you bought an ad in the fourth quarter, you were happy because it was a competitive game, and that's really what you're looking for.
I saw that some spots cost $7 million for 30 seconds. Yeah. I guess if you have it, you might as well spend it. But is it placement? Is it, you want to be around the halftime show? Do you want to be around the fourth quarter or the first quarter, since a lot of us, you know, only watched the very beginning and then went to bed?
Right. No, so yeah, exactly. So, you know, the first quarter, the beginning of the game is certainly some of the prime real estate. Then the real estate around the halftime show. For a lot of people, they don't necessarily watch the game. They watch the halftime show. And of course, it was a huge halftime show for NBC. So if you had ad placements around that, that was great. But what was great for NBC and for the game in particular was that it was a competitive game right down to the last seconds of the game. And that's really what you want if you're an advertiser, if you're a fan.
Yeah, game was great. Halftime show, have to say, was great. Snoop, Mary J. Blige, 50 Cent, Upside Down, Eminem was there as well. When you talk about viewership, though, and why advertisers would pay this much for 30 seconds, has it been going on the up? Because I thought none of us really watched TV anymore.
Yeah, I mean, I think what we found in the world of cord cutting and more of us watching streaming, that's an issue for all advertisers, for all programmers. But one thing that has really stayed really constant is sports. And sports are really key for advertising and really key for audience, and nothing's bigger than the Super Bowl. So every single year, the Super Bowl is huge, and that's where advertisers want to be. Even the Olympics. So NBC has the Super Bowl, but also the Olympics. So it's just been extraordinary for NBC to run.
He's been watching every day.
Yeah, it's been a big couple weeks for NBC. I myself only really watch the figure skating. I'm more of a Summer Olympics kind of gal. People aren't just watching, though. They are also increasingly betting on these games, and not just, you know, the outcome or the final score, but little individual things like who is going to complete the most passes. How do you view the NFL's embrace of online gambling at this point?
I tell you, just as recently as 2 or 3 years ago, the NFL was completely against betting in any shape or form. But since it's been legalized in about 30 states and more coming, they've really embraced it. So it's betting's become a real big part of sports in general, including the NFL and including the Super Bowl. So you see ads across the NFL broadcast for these betting sites across the board. So it has become a real big part of the sport.
Hey, Paul, Danny here in London as well. Thrilled to have this conversation because where I am, most people have a very wrong idea of what football is. But I wonder if you look at, I wonder if you look at all these crypto ads we saw during the Super Bowl, if any sort of memory comes to mind to you, specifically 2000s and when we had sock puppets for pets.com.
Right.
Is it a warning sign?
You know, it's interesting. I mean, I think I was right there in the 2000s on Wall Street selling these .com stocks. So, but I think the issue here for crypto is it is an asset class, and I think most investors feel like they're not really sure about crypto right now. But I think even Jamie Dimon at JP Morgan is not really sure about crypto right now. But I mean, it is clearly, I think, an asset class here. And I think most investors are embracing it, whether it's the retail investor or institutional investors as well.
I thought about Jamie Dimon when I was watching this Larry David commercial. Because Dimon is sure. He says it's worthless, right? You know, which is kind of like what David was saying about the light bulb when he was talking to Edison or whoever that is there. On the other hand, huge amounts of money are in this asset class. So, you know, whether you're against it or not, you might as well be for trading it, right? And that's who was putting all these ads up. The Coinbase one was weird. Did you scan the QR code?
I mean, did not scan it.
The kids loved it, but I didn't.
I was kind of lying back on the couch with maybe a cold adult beverage in my hand, and I didn't necessarily have the wherewithal to scan it. But at the end of the ad, I finally got oh yeah, I think I'm supposed to scan something here. So I thought it was a very cool ad. I looked at, I just said, hey, this is going to be talked about tomorrow.
Yes.
And that's all you want if you're buying a Super Bowl ad, to be talked about the next day, maybe the next week, the next month.
Or even in the moment. I was looking at my Twitter feed after that ad, and there were people who absolutely hated it, thought it was the dumbest ad ever, and people who said, hey, this is brilliant, but everyone was tweeting about it. And I think at the end of the day, that's the goal. Bloomberg's Paul Sweeney, thank you so much. Danny, I scanned the QR code. I'm just going to say that. I'm a journalist. I'm curious. I needed to know what it was about.
I couldn't bring myself to do it because I felt the frustration of the Windows screensaver of that little QR code not getting into the corner. I couldn't. Oh, so frustrating.
And in like
so frustrating.
8-bit as well. It was bad.
For that reason alone, I would not grant it with a scan. All right, coming up, we're going to be speaking more about crypto with Jesse Powell, CEO of digital currency exchange and trading platform Hayward Inc. That's at 5:30 p.m. in New York, 10:30 p.m. in London. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York, and Danny Berger is in London. And also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance. Tom, what I really want to talk to you about is Super Bowl and all the great ads that were out there. But unfortunately, it is actually also a big market day. Commodities in focus, stocks taking a leg lower.
Well, of course, all off of Ukraine and the news flow that we'll see from Moscow, from Kiev, and from Washington, and points in Europe as well. The litmus paper here is oil. Let's look at a chart that goes way, way back off the Bloomberg. This is an approximation of inflation-adjusted oil using long-term charts back to the 50s. This is Saudi Light and an inflation series from the United States. So I'm going to call it an approximation off of the Nixon break in oil. Then up we go, 2 rounds of OPEC, the collapse in 1986, a little spike in the middle of the chart is Persian Gulf 1. And up we go to $96 a barrel right now. Where is oil, Kaylee, when we say $100 a barrel? The average price in today's dollars is about $118 a barrel. That's a pretty good approximation of the pain that we had a number of years ago.
It's interesting that you bring up the Nixon break, because I equate that with a shift from big block, big inch muscle cars to, you know, tiny little, that's when the Ford Mustang went from something glorious to something laughable.
Absolutely.
And maybe that's what we want right now. You know, maybe that will drive consumers to EV demand, because I've been hearing a lot about demand destruction at these price levels.
Yeah, I think it's a topic, Matt, that we could spend an entire show on. And I will tell you, living it, that there were seismic shifts driven by consumers in OPEC, what I call OPEC 1 and OPEC 2. And the parody of it is a VW Rabbit, which John Farrow thinks is a Golf. But you're right. It was a tumultuous time for engineering as we confronted the new price of oil. I don't see that right now, but it's definitely worth a study.
All right, Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And of course, we have to pay attention to a number of things today. I am watching Ukraine tensions, really one of the reasons why we are watching oil in particular. It seems that there wasn't any real progress over the weekend. President Biden talked to Vladimir Putin, seemed kind of inconclusive. He also talked to Vladimir Zelensky, just reiterated things that he's already said. So my question really is, when Olaf Scholz heads to Ukraine today and Moscow tomorrow, can the German leader make any more progress, especially because he's been caught in a very tough position, hasn't taken the firmest stance on this particular issue, Matt. So it'll be interesting to see how this plays out over the coming days.
Yeah, we'll be paying very close attention, and I'm watching commodities for that very same reason. But it's not all about oil. You know, Javier Blas, our brilliant energy investigative reporter who wrote The World for Sale, the book The World for Sale, has an opinion piece on the Bloomberg today about how aluminum is where inflation is headed. So it's really across the commodity sector. And here you see the BCom Commodities Index. Danny?
Yeah, I'm also watching 13Fs. Hedge funds have to file that. That's, of course, the quarter prior, so a little bit outdated, but should be interested if we see this shift from value away from growth. Now we have more Bloomberg Surveillance ahead of you. We're going to hear from JP Morgan, among others. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The real question for the Fed is, do they want to surprise in a dovish direction?
Their patience will be rewarded if they do not get aggressive here early on in the cycle.
I would like them to just get on with it. Let's do 50.
They've been going 85 miles an hour in the left-hand lane, and they need to catch up, and they need to catch up quickly.
We actually think that the Fed comes into this year like a hawk and leaves this year like a dove.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Some risk aversion in this market from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. TK, your equity market down 0.8 on the S&P, on the NASDAQ down about 1%.
The VIX going through the 30 level, John. We had a 31 handle moments ago. Yeah, there's some ace in the equity market, but all of it linked into commodities with the global metric right now being Brent crude. We got up to 96, 94. 72.
Janet Henry and the team at HSBC, Tom. The last thing the recovering global economy needs right now is another leg higher in energy prices, yet that is what it's getting.
The leg is there. I did the math. I just did it with Matt Cayley and Danny, and it's real simple, John. The over $100 a barrel level in 2022 dollars is $118 a barrel. That was sort of the average price set in today's dollars, the last bout over $100. So that gives you a mark, John, sort of to look to.
Crude tidally into the 90s, 93.40 on WTI. Bramo, you missed nothing.
Oh, yeah.
Welcome back.
Well,
welcome
thanks.
back.
I heard I missed nothing. I mean, if you look at yields right now, they're almost the same place that they were when I left, so I imagine nothing happened. Look, it seems like it was an incredibly eventful couple of days. The interesting thing about oil prices is some of the projections about what that means for global growth, whether it's Mike Wilson, who's becoming known as a perma-bear, even though he's really not, or anybody else. Bloomberg Economics expects that $100 a barrel oil, which is not very far away, would take about a 0.5 percentage point off U.S. and European economies over the second half of this year.
Goldman cutting their forecast going into the weekend too. That seems to be off the radar this morning, given what's happening with equity futures and elsewhere. But 4,900 on the S&P for them year end, down from 51.
But that's a bullish call at this point because that still is 11% upside, right? There are people who are coming in even further with Mike Wilson saying that there's a polar vortex of risk here with respect to the UK and Russian complex. You know, there's a diversion of opinions.
There is, and we'll go through them through this morning. TK's always got something to talk about. Get that view from Tom Keene in just a moment.
You know, what happened over the weekend? What happened over the weekend and what we're really going to focus on this week, particularly with retail sales coming up in a few days, John, is growth. Mike Wilson mentioned it. He's focusing on growth. We've been talking about it. John, I think we've been out front on this. At the end of the day, it is about economics and what is GDP going to be real and nominal.
Well, Tom, when you read through that Mike Wilson note from Morgan Stanley, and thank you for that, Mike, consumer confidence on Friday, Tom, fresh decade low. That's where his focus is right now. Higher prices are starting to hurt confidence, and in his mind, that'll hurt growth too.
And the bulls will say we've had a nice washout, a correction, if you will, and certainly a correction in behavior, and you've got to go optimistic here. I mean, again, we start the week focused on growth and focused on these raging debates, plural.
Futures on the S&P down 0.8%, on the Nasdaq 100 down about 1.06%, down 150 or so.
You didn't even dress up for
on
Valentine's
the
Day.
Have you dressed up for Valentine's Day?
Look,
Who's that for?
on radio, it really works.
Okay, do you want to come back to that in a moment?
Yeah, we'll do that in a moment.
Have you said Happy Valentine's Day to Mrs. Keane? Is this your opportunity to do so?
Oh, no.
Okay. I was trying to have a serious show this morning, Tom.
I know, I can tell.
Thank you. Yields down a couple of basis points on 10s. Lisa, 191.81.
How's that serious show working out for you? Today, what we're looking at, there isn't as much data as there is it later in the week. We get those retail sales, as you talked about, John, but we do get German Chancellor Olaf Scholz heading to Ukraine today. Tomorrow, he's heading to Russia. Key to see how he indicates they are thinking about that Nord Stream 2 pipeline, as well as gas prices, which surged over the past few years, but in particular over the past few months. And overnight, they surged 10% on some of the renewed tensions to its highest levels since January. 11:15 a.m., we get some words from ECB President Christine Lagarde. She's addressing the EU Parliament. What will she say about the rise in yields that we have seen in the region? It has come down a little bit because of some of the concerns about Ukraine and Russia, but still there is a sense that it is incredibly likely that they could start talking about raising interest rates by the end of this year and moving away from negative rate policies for the first time going back to 2016. At 11:30 a.m., there is a routine meeting. I repeat, routine meeting. It is not an emergency meeting of the Board of Governors of the Federal Reserve. However, it is interesting given how much concern there is about some sort of stabilizing action by the Federal Reserve. Mary Daly on CBS's Face the Nation over the weekend, San Francisco Fed president, came out and said abrupt and aggressive action can actually have a destabilizing effect on the very growth and price stability we're trying to achieve. So what I favor is moving in March, watching carefully, and then deciding on how to take the next steps in a gradual and measured way. This actually gave some comfort to markets. Does that work, John? Does it have a lasting effect? Or is it just basically going to be trigger happiness depending on who talks? And you do see that 2-10s yield curve continue to contract, giving a pretty negative opinion on the global trajectory in the U.S. economy going forward.
Have you seen how much Fed speak is out there this week?
It's insane.
It is.
And, who do you listen to? But, John, who do you listen to? I mean, honestly, it's like each person, Jim Bullard had an incredible effect on markets. Then you saw markets swing with, with Mary Daly speaking. How much are we depending on language that really doesn't make a difference, given the fact that Jay Powell really holds a lot of the keys?
If you ask me for whatever my opinion's worth, TK, I think Chairman Powell needs to put in a speech somewhere in the next couple of weeks and just get a hold of the narrative and talk about what they're about to do.
I strongly agree with that, and we've seen that many, many times before where the big guys got to come out and reset the landscape as they stagger to March 16th. Again, there's that inflation number. What is it, John? March 11 or March 12?
March 10th, I believe.
I'm sorry, like inflation last week when Lisa was gone, retail sales this week is a big deal.
Looking forward to the data a little bit later this week. Joining us now is David Kelly, the Chief Global Strategist at JP Morgan Asset Management. David, this quote from Morgan Stanley and Mike Wilson on a spike in energy prices, quote, would destroy demand in our view and perhaps tip several economies into an outright recession, the polar vortex. David, do you agree?
None of it's just energy prices. I mean, there is a risk, of course, if we get an all-out war in Ukraine. I mean, we don't know how far that goes, and the long-term implications could be significant. But if it's just tensions, higher oil prices, it's not enough. I mean, there's a lot of momentum in the U.S. economy, there's a lot of momentum in global economies as we come out of the pandemic. There's a lot of pent-up demand. So I think the world can handle oil at 90 or oil at 100. If it has to handle that and a big war and all the uncertainty that comes with that, it's a different matter.
David Kelly, if we assume buoyant nominal GDP, whatever the makeup is of real GDP and the inflation dynamic as well, how do we fare given buoyant nominal GDP?
Well, it helps corporate profits, and it is kind of what it is. I mean, there's a lot of talk about Fed policy and the Fed being more aggressive, but that's going to have an impact in later this year in 2023. For right now, the economy is, it's going to be slow in Q1. Those are still going to be low numbers for Q1 GDP. Then it's going to boom in Q2, and then it's going to slow as the year goes on. I think that's true for, inflation's obviously high in Q1, but I think inflation will also be fading as the year goes on. So that's what we've got, and I think the Fed needs to just take it easy here in normalizing policy, and don't think that they can actually fix all of this at one sitting.
Well, do you think that the message from the yield curve is basically saying just that, and it's an important and instructive tool right now for why you think the Fed should not move perhaps as aggressively as people are pricing in?
Yeah, because I think the yield curve is telling us that the Fed is going to overreact and then pull back. And that's exactly what the Fed should not do. What the Fed should do is what Mary Daly was saying over the weekend: be patient, be gradual. 25 basis points per meeting, next 4 meetings, get going in the balance sheet over the summer, but just keep at it. Don't get spooked and try to get back to normal rates. But the yield curve saying nope, they go aggressive, and then they have to pull back when something goes wrong with the market or the economy.
David Kelly, this idea of engineering a soft landing, just how wide open is that window still to do so?
Well, there's some it's bumpy anyway. It's kind of like a plane coming in with the wings flapping all over the place. You're wondering, should you have the option of going around and trying it again? It is bumpy because we've got very low growth in the first quarter, booming inflation. But again, there's not much we can do about it. A lot of this has to do with just waves of distortion caused by the pandemic itself. And I think you just have to sort of play it out. But, could we achieve a soft landing? Yeah. I mean, the economy does seem to have a natural tendency to put out sort of 2% growth per year and 2% inflation per year. There are a lot of years which look kind of like that. And I think we can get back to that. But it is looking a little bumpy and challenging right now.
David Kelly, thank you, sir. As always, of JP Morgan Asset Management, a difficult time in this market. I'll just share with you what's on my screen right now on the Bloomberg terminal. Tom Keenick's European banks, and it is just a sea of red out there right now. SocGen down by 6.6%, BNP down by more than 5%. Think about where we've come from. This index, this sector, this industry was up more than 14% through Friday off the back of this conversation, Tom, of higher interest rates, higher bond yields in Europe. We're backing away from that story this morning.
Well, we've backed away over the last week, but you're right to make it a regional story, John. And the regional tone of what we see with Russia and Ukraine, and frankly with the rest of continental Europe, is that regionalism. And yeah, it's going to redound into the Bloomberg world as well, including ECB policy. Can I state, John, that what Lagarde stunned us with has been totally walked back? I think that's close.
Pushed back. I wouldn't say she's walked back what she talked about last week. I'd say what's happened, Tom, is she's pushed back against how aggressively the market priced off the back of what she was talking about last week. There's a bit of a subtle difference there. If you think about the sequencing, Tom, the first rate hike from this ECB is only very likely to come at the very back end of this year, if indeed it comes this year, and the market was pulling it all the way into summer. That's where the pushback has come from.
John, I'm looking at Euro Swissy as one barometer there of the tensions as we follow this, and we'll have a lot of reporting on Ukraine today. But John, 2's10 spread really caught my eye when I walked in the door here at 5:55. I mean, under 40 basis points gets my attention.
Classic risk aversion for me, Tom. Lisa, you look at bonds, yields come in. You look at foreign exchange, the yen is stronger, the Swissy is stronger. You look to European equities, banks are down, they're down hard.
I think they're two different stories, though, in Europe and in the U.S. In U.S., it is classic risk aversion. In Europe, it also is. Yet the spread, the differential in Italian yields continues to remain at the highest levels going back more than a year. What is that message telling you, John?
Coming up on this bond market, Sabadra Rajappa, the head of U.S. rate strategy at SocGen. We'll get into that question that Lisa just posed a little bit later. And next, we'll head down to Washington, D.C. and get you the latest on the tensions over Ukraine. From New York City, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Ambassador Bridge that links Ontario with the US has reopened after a 5-day protest against vaccine mandates. Stop traffic. Authorities started clearing demonstrators this past weekend before working to remove barriers erected at the site. The Ambassador Bridge handles an estimated 25% of trade between the US and Canada. Pakistan is warning that Afghanistan could descend into chaos and threaten regional stability. Prime Minister Imran Khan said in a CNN interview, pointed to the U.S. refusal to recognize the Taliban, coupled with sanctions and frozen assets. Khan says foreign governments have no choice but to try to work with a group to avert a larger crisis. And Swiss voters have backed a ballot measure to protect children and young adults from tobacco advertising. Nearly 57% supported the initiative. Switzerland lags behind most wealthy nations in restricting tobacco advertising. That's a situation widely blamed on lobbying by some of the world's biggest tobacco companies, which are headquartered there. And Japan's second largest startup, Money Forward, says more work needs to be done to boost the nation's venture capital sector. The fintech firm's chief of public affairs, Toshio Taki, tells Bloomberg that the lack of willing risk takers means promising companies still need to look abroad for capital, despite Prime Minister Fumio Kishida making startups a key focus for future growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
The way they have built up their forces, the way they have maneuvered things in place, makes it a distinct possibility that there will be major military action very soon.
The message from Jake Sullivan, the U.S. National Security Advisor from New York City with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market is down 37. We're down 0.8%. Let's call it 9. On the Nasdaq 100, we're down a little more than 1%. Yields come in a single basis point to 192.50. In foreign exchange, the euro weaker, the Swissy stronger, so is the Japanese yen. Just a bit of risk aversion out there, Tom Keene. Crude, 93.29, up 0.2%.
We don't talk enough here based in New York about dollar ruble. There's different ways to look at ruble, John, but my mark on 2 standard deviations is not out to record weakness, or recent weakness, I should say, but 79.40 is important to me. Right now, 77.06.
What I expected to see in this equity market this morning, Tom, I'm seeing with the banks in Europe down and yields coming in Germany. That's the playbook.
I think it's orderly, absolutely. We'll mention 2-cent spread. Right now, as we move forward and Washington moves forward into an important week, Anne-Marie Horton joins us, our Bloomberg Washington correspondent. Emery, I think over the weekend what I heard was a nascent containment by President Biden. This goes back to George Kennan, his arch article of 1947, when in doubt, contain. Is it your reporting in Washington that we are setting up a policy of containment of Mr. Putin's desires?
Well, honestly, nothing really changed over the weekend. That phone call between President Biden and President Putin basically says that both sides still has the rhetoric that they have been for the past few weeks, and they have not moved an inch closer to an off-ramp for President Putin or a diplomatic ending to this. So the only takeaway I have from the Washington briefing and the Moscow briefing following that phone call is that both President Putin and President Biden agree that their team should remain in contact, but the rhetoric from both sides is the same, which is setting up for a very challenging week. You have Olaf Scholz, who's going to try his hand in Kyiv and then Moscow, but this comes as the United States says that Russia could launch an invasion before the end of Olympics. Right. We heard that from Jake Sullivan on Friday, but we should note that so far Russia continues to maintain that they have no intentions to do so.
For our American listeners and viewers, and I mean this on a diplomatic sense, is for the Russians is it divide and conquer where they're talking separately to continental Europe and separately to the United States?
Well, that's part of it. President Putin doesn't want a heavy hand in European policy. He has said that and has shown that for years. So what he is doing is it's easier for him, obviously, to meet these individual leaders one-on-one and see if there's any kind of concessions he can get from any of them, particularly the ones in Europe who businesses are very much so integrated with the Russian economy. So that is what he is trying to do. But we should note that since President Putin and Biden spoke December 30th, this whole month of January leading into February, the U.S. has worked tirelessly dispatching a number of officials to Europe and vice versa to make sure that they could try to confront Russia in a unified front. And that is what they learned from 2014 when Putin annexed Crimea.
Anne-Marie, when it comes to informational strategy, because the warfare has been on that front on both sides for a while, what do we make of the fact that the U.S. is releasing information almost as soon as they get it about potential military action by Russia?
Incredibly transparent from the United States and almost in a way that seems very aggressive, as you say. And the New York Times really had a weekend piece that detailed all of this step by step. And part of that was also what the United States is doing on the diplomatic front with their engagement with European leaders. What they want to make sure they do is what they did not do in 2014. In 2014, they did not release the intel they had regarding a potential annexation and invasion of Crimea. So they have changed path. potentially learned from what maybe they would call a mistake of 2014, and they are trying to get that information out now. And when Jake Sullivan, I was in that briefing room on Friday, was asked that there have been instances in the past, a la Iraq War, that the U.S. had put intel out there. What he said, the very difference is the information I'm giving from this podium compared to prior to 2003 is that we are trying to avert a war. We are not trying to put intel out there so we can go into a war.
So that's proactively trying to get ahead of a weapons of mass destruction type of proclamation or accusation of that type of activity. But what could the strategic benefit be for the United States giving out this information now in terms of deterring Putin from actually going through with the invasion?
Well, many would say that it is going to change his calculus and the calculus at the Kremlin. If you have all of this information on the global scale, and Russia has in the past used false flag reports, potentially if they were going to do that again, we have to say that Russia at this moment still says that they have no plans to invade. But if they were to, now this is out in the open. So Putin's credibility will be hurt on the international stage and globally. But also this potentially, it divides his calculus on whether or not he should potentially go in or not. They are really mapping this out across the board so that no one can, if he was to invade, say, we did not warn you. Politically, from the American standpoint, it is very smart, because if Putin were to invade, they could say, this is what we have been warning for weeks. We told American citizens to get out. We have told our European allies this was coming. And if he doesn't, they will take this as a victory that they deterred him from invading Ukraine.
Anne-Marie, almost exclusively, this story has been covered either by the US perspective, the European perspective, or the Russian perspective. Not enough coverage of where the Ukrainians stand on all of this. There was a really interesting comment in the last 24 hours by the country's ambassador to Britain about maybe leaning away from any hope to join NATO in the future. How important was that line, that comment to the BBC?
Yeah, when I heard that line, I was pretty shocked, to be honest with you. This is saying out in open, we might come out and say we won't join NATO, and that potentially will deter Putin back, because that is certainly what he doesn't want. He was complaining, apparently, in the press briefing on the Moscow side about the Minsk Accords, which is a way in for him to potentially halt Ukraine joining NATO. The one thing, Jonathan, is since that remark was made on BBC, the Ukrainians have walked it back a number of times. So clearly, potentially, that ambassador in the United Kingdom got a bit over his skis.
AMH, down in DC. Anne-Marie, thank you. Tom Keane, an important week ahead.
An important week ahead, John, and I think the thing that we have to really focus on is what to watch for. And I do agree with Anne-Marie, as the German leadership, the new German leadership, and their trek to Moscow, it's trenchant, John, when you look at the history and the emotion of that. And John, I'm going to make it clear, I would suggest the emotion is still there, the ties between Germany in Berlin and Moscow. I mean, it's just steeped in history.
Oh, Tom, you want to talk about the history? Let's go back, all the way back to that line from Secretary Baker. When was it? In the early 90s? Not an inch to the east.
Yeah.
And how much still we argue over that very line.
Yeah, Angela Stent had a wonderful comment I read this weekend. It was a Henry Kissinger quote. John, if I have to call Europe, who do I call? And I think that's, a very important emotion right now. Do you call Brussels? Maybe you call a prime minister in the United Kingdom. I don't know.
Tom Keane, alongside Bramo, back in a hot seat. Good to have you back, Lisa.
Thank you.
I'm Jonathan Ferro. Futures down 0.8 on the S&P, on the Nasdaq 100 down a little more than 1% from New York. Heard on radio, seen on TV. This is Bloomberg Surveillance.
U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
You can pick your poison this morning. Geopolitical risk, inflation, the Federal Reserve futures are lower, down 0.75% on the S&P, on the Nasdaq 100, down a little more than 1 percentage point. Goldman Sachs go from 5,100 year end to 4,900. David Kostin pointing out this is not about earnings, this is about valuations. And when they put out that forecast for year end 22, they were only looking for 2 hikes at the Fed. Now they're looking for 7. That's the equity story. Here's the bond market picture. Take a look at 2s and 10s in the US and 2s and 10s in Germany. Let's start with the US. That spread between 2s and 10s right now, 40 basis points, very briefly in the 30s. First week of this year, January 7th, we were just short of 90 basis points. We've cut it in half and some. That yield curve is flatter, flatter, flatter. In Germany, yields come back in, down 7 basis points on 2s, down 8 on 10s. And with that, European banks underperform in a big, big way. Capturing that, Tom, for me, the risk aversion for you too, I know. Finish on this. It's the Swissy, the strength in the Swiss franc, Euro Swiss, Tom, that currency pair comes in about 0.5%.
About halfway in on the distribution, John. I don't want to get into all the math right now, but a 104 is a 104. A 105 is weaker Swissy. And John, actually the trend going back to Thanksgiving is a Swiss franc under 104, stronger to a 103 handle. And there's no indication of that, but that's that glide path that screams tension.
What do you make of this move in crude, Tom? Just pulling back, negative on the day now, 94.23 on Brent, down 0.2.
I think there's a lot going on here, and I think some of the work over the weekend was really extraordinary, and particularly by our Julian Lee, John, in London. He absolutely nailed the reset that demand appears to be greater than the pros are calculating, which gives you a nudge up in price away from the tensions of Ukraine.
And we've had more than a nudge up in price year to date, that's for sure, Tom. Brent right now, 94.24.
Right now, Lindsay Piegza joins us, our first briefing of the week, the chief economist at Stifel. We're thrilled that she could join us this morning. Lindsay, let's just get back to the recalculation. I'm sure you did over guacamole last night on the couch, and that is the terminal rate of inflation, whether it's the near rate out, say, 1 year, or a rate farther out. What is the trend that we're heading towards on inflation?
Well, right now, it seems as if inflation has nowhere to go but up. But as demand, pent-up demand, it is satisfied. And as we start to see some of these supply chain disruptions smoothed and balances restored, we would expect to at least see that second derivative decline or a slower pace of positive price increase set in by the second half of the year, giving us a nice downward trajectory then as we head into 2023. And this is really what the Fed is banking on.
Right.
The Fed is very much convinced that inflation is near or at peak levels.
Do you agree with this? I mean, the Arch research note this weekend is it 2 or 3% is a statistic, or is it 4 or 5%? What is the path we're going to, even with Fed hopes and dreams?
I think we could easily see 4.5% by the end of the year and a continued downward trajectory as we go into 2023. So when we put that in perspective to the Fed's target of 2%, the takeaway is that we're likely to be well above that target level for quite some time. But again, for the Fed, for the market, it's the trajectory of inflation that's really going to set the tone for the expectation of a change in monetary policy over the next 12 to 24 months.
Lindsay, how do you push back against the assertion that inflation is becoming more entrenched? And you could see this in rent prices. You could see this in the fact that CPI came in that much hotter than expectations that already were for a pretty hot inflationary environment.
Well, remember, there's two types of inflation. There's the demand side and then there's the supply side. On the supply side, production costs moved up quickly because of these supply chain disruptions, distortions, and imbalances. That's the component that the Fed was very much focused on, the transitory component, if you remember that language. And we do expect that to ease in the medium term, again, as balance is restored across the global marketplace. And we're already starting to see a little bit of price pressures ease, looking at the PPI, with this week's report expected to ease further. On the other side, you do have the demand pressures, and that's where the entrenchment, the concern of this wage price spiral is really setting in. And that's going to be the component more difficult for the Fed to control going forward if, in fact, we do see this more entrenched as prices rise across nearly every sector of the economy.
So do you see a wage price spiral at this point, given the fact that real wages are still deeply negative, for some measures, the most negative since 2007?
Well, they certainly are still negative. When we talk about that 5 to 6% wage increase, it's certainly less impressive against the backdrop of 7% inflation. But we're still seeing that cycle set in. Higher prices leading to higher wages, leading to higher prices. So the wage price spiral, although still inefficient for workers, has very much set in, at least over the previous, I would say, about 6-month period.
Lindsay, let's look forward to retail sales. We've got a few distractions on a Monday morning, but the key distraction of the week is this measurement of the American consumer. Is it good math worth focusing on?
Absolutely. It tells us the health of the consumer. It tells us the comfortability of the consumer to move back into the marketplace. Now, if you look back to the third quarter and the end of the beginning of the fourth quarter, we had sort of this buy now mentality, the fear that inflation was going to continue to rise. So we needed to buy what we needed today because tomorrow it was going to cost more if it was available at all. So what we really saw was a lot of these metrics pulling forward traditional end of the year holiday spending. These measures, though, this momentum is likely to wane as we look further out into the first quarter. And we already saw that weakness in December retail sales. So if, in fact, we do see this weakness carry forward into the first part of the first quarter, I think this reinforces the notion that pent-up demand is already being satisfied. Savings through the pandemic are already being drawn down. That trillions in savings has depleted markedly. And this is going to lead to a much more modest pace of growth for the longer run in the domestic economy.
Well, what is your real inflation call for this year that gets you to nominal GDP? Give us those three statistics that you see. Real GDP, the inflation out to the end of the year, and the total nominal GDP statistic.
Well, I think real GDP slows to a range of 2 to 3%. You factor on about a 4% inflation figure at the end of the year, and you have a nominal GDP rate around 6%.
All right, Lindsay Pieggs, one thing a lot of people are talking about this morning is how oil prices might change the equation pretty dramatically and actually could eliminate quite a bit from GDP. How do you factor that in? What's the choke point for oil prices?
Well, I think the fastest way to derail the consumer in the American economy is raising gas prices, the sustained elevated gas prices. And we're already seeing that with double-digit gains across the country, with some of the highest prices, of course, being felt out on the West Coast. And so when we look at the consumer, when we look at the health of the consumer, and we talk about businesses being able to pass on these cost increases, well, if the consumer is already absorbing sizable price increases in some of these very key categories, i.e. energy and groceries, businesses are going to have an increasingly difficult time passing on further price increases if the household balance sheet, the majority of the household balance sheet, is being allocated to those two categories.
So, Lindsay, do you have a level, a choke point level? And I wonder, because I heard some people say $115 a barrel, some people saying it has to get back to $150 a barrel simply because of inflation.
Oh, I think the consumer is on much more fragile footing than that. I think the choke point would be a lot lower, between $90 to $100. So we're rapidly approaching or even teetering into that category already.
So I'm just wondering, Lindsay, just quickly to follow up here, this idea of $90 to $100 a barrel, we're there. Are you saying that at this point, if oil prices are sustained where they are, the U.S. will not be able to avoid some sort of downturn?
I think it's very clear that as the economy continues to recalibrate to a new normal level, we are already set to slow markedly from that 4.5% range in the second half of last year. I do expect GDP to remain positive, but slow to a range nearer 2 to 3%, which, if you remember, is very much in line with pre-pandemic growth. We tend to romanticize where we were prior to the crisis, but growth was already slowing from 3% in 2018 down to 2% in 2019. And with a moderate consumer, with elevated inflation and rapidly rising energy costs, I think it's a very clear trajectory back to that pre-pandemic growth rate of near 2 to 3% GDP.
Lindsay, thank you. Lindsay Piesa of Stifel. Those questions you're asking at the end, Bramo, are so important just on the energy front. If you get another leg higher in energy, but this time it's driven by a supply shock because of something like Russia, that rock and the hard place the Fed is stuck between, that rock gets a whole lot bigger, that hard place gets a whole lot harder. What on earth do you do as a central bank if that's the case?
Especially when you get the political pressures that you're hearing from the likes of Joe Manchin saying the Fed has to get more aggressive. This will only accelerate some of that inflationary pressure, but it is long-term. I mean, there's a big divide here of whether this is disinflationary or inflationary. There often is a disinflationary pressure because people buy less. People feel less good. They cannot buy as much with their paychecks, and we are already seeing that. And if that's the case and it persists, how much more does that become entrenched, taking us back to where we were, and even lower growth than we were before the pandemic?
Well, that's the old line, isn't it, Tom? The biggest cure for high prices,
yeah.
But to get high prices lower, it's growth that hurts.
The AAA unleaded up in nickel here up to $3.49, and that's just a blended price that, John, to be honest, a lot of people don't believe in. They know the price of a gallon's a lot higher. I do agree, John, and this goes back to Gerald Ford and whip inflation now, which was a folly from day one, is there will be a struggle in Washington if this trend continues.
There's a struggle in this equity market, Tom, that's for sure at the moment. We're down 3/4 on the S&P. Yeah. We're down about 9/10 on the NASDAQ 100. Yields coming in 2 on 10s, down 2 basis points to 191.98. That's the picture in the US. Bear in mind that we had a late correction on Friday, so Europe kind of sat that one out.
Yes.
The CAC 40 in Paris is down 3.5%. That's the catch down play.
No,
the equity benchmark in Frankfurt, Germany, Tom, the DAX is down 3%.
It's a really strong observation, folks, and that as the world turns, the markets catch up, they slow down, they get behind. And I would say you're dead on, and with the VIX at 30.84, rounded up to 31, the market sort of feels like a 34, 35 VIX, but we're not there yet. That bears watching.
Lost in this conversation as well, Tom. We're just backing away from COVID restrictions, state after state, country after country. We need to have that conversation with Joshua Sharfstein, the Vice Dean of the Johns Hopkins Bloomberg School of Public Health. We'll do that very shortly. With futures down 0.75%, yields coming in a couple of basis points to 191.98. And in the commodity market, crude backing away just a bit, 92.88 on WTI, down 0.25%. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Joe Biden told Ukrainian leader Volodymyr Zelensky on Sunday that the U.S. and its allies would act swiftly and decisively if Russia were to invade Ukraine, echoing comments he made on a Saturday call with Russia's Vladimir Putin. The U.S. says an invasion may be imminent, while Russia has repeatedly said it has no plans to invade. German Chancellor Olaf Scholz is set to meet with Putin in Moscow tomorrow. Hong Kong's daily virus cases topped 2,000 for the first time ever, with the worsening outbreak threatening the city's COVID-0 push. Health authorities announced 2,071 cases today, as well as 4,500 preliminary infections. Cases have exceeded capacity at Hong Kong's hospitals, and Hong Kong officials have asked for Beijing's support, including help with test kit supplies. Saudi Arabia transferred an $80 billion stake in Aramco to the kingdom's sovereign wealth fund, boosting its assets ahead of plans to tap debt markets for the first time. The deal, which essentially transfers an asset from one pocket of the government to another, is the latest move taken to bolster the fund's assets. And Clarion shares fell the most in more than 2 decades after the company announced it was investigating allegations by internal whistleblowers that staff manipulated accounts to meet financial targets. The Swiss chemicals company says it may need to restate results for 2020 and for the first half of this year. And the Los Angeles Rams beat the Cincinnati Bengals 23-20 to win the Super Bowl on Sunday. The victory gives the Rams their second ever Super Bowl title and their first as a team based in Los Angeles. The Rams scored a touchdown with less than 2 minutes left in the game to take the lead. Cooper Kupp was named the Super Bowl's most valuable player. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now